Good morning, everyone. Am I audible and can you see me clearly? Right. So, am I audible? I am audible, right? Right. Okay. Thank you. So, good morning again. Welcome to the final session of this CMA short course on professional cost accounting for professional effectiveness. And today also we are going to have a small guest lecture session at the end of this session. And we will start discussing the theoretical aspects. Today's lesson is on standard costing, as you can see, and we have shared the materials as well. And after that, we will be moving to the guest lecture. And especially before starting today's lecture on standard costing, we will see your assignment guidelines. That is important as this is the last day. You need to have a good understanding about your assignment. So let me go through the assignment first and then we'll start the lecture. Right. Right. So I hope you can see my PDF and can you please confirm whether you got this PDF assignment guidelines? Or else I can now put it into chat box as well. Not received. Right. So I shared it in the chat box. You can download there. But I will ask CMA again to reshare this document with you because there are only 12 participants at the moment. Right. Okay. So this is the assignment guideline. It's actually a synopsis submission. You need to write a synopsis and then you need to submit. We'll read it. And application of cost accounting. Yes, coming under assignment overview, application of cost accounting concepts in the workplace. That means make it full screen. This is, how can you see this? It is, right? Okay, right, that's true. So for the course assessment, you are required to submit a 750-word synopsis, which illustrates how the concepts discussed during the course can be applied in the context of your workplace. Now, it's kind of a practical thing. You have learned different concepts, theories, theoretical aspects during the lectures, and also you had some guest lecture sessions explaining how these concepts can be applied in the workplace practically as well. So you need to apply these any theory or any concept or any important thing we discussed in the lecture in your workplace, right? So that is only a 750 word synopsis. This assignment is designed to assess your understanding of the key topics covered in the course and how you intend to implement the knowledge gained to improve workplace efficiency and decision making. So basically, it's about your workplace. So let's say, as my understanding of from the first session, some of you, a minority of you, are not working at the moment. If that is the case, hypothetically, you can think about an organization. You can write this, but if you're actually working, make sure you are applying and you are critically thinking about these concepts and writing how you can apply these concepts into the workplace. So this is the assignment outline. I have given an outline as well. You need to write an introduction, approximately 50 words for the introduction. So you can briefly describe your organization, its industry, and your role within the organization. That's how it goes, right? So if you don't want to mention your organization, if it is a sensitive information, no problem. You can write ABC, XYZ like that. So don't worry about it. But make sure you apply the concepts into the real world scenario. That's the most important thing. And the second one is key accounting concepts and their application. That is the most important part, 500 words approximately. Identify three key cost accounting concepts, so practices covered during the course. Now, we discuss so many concepts, right? We discuss so many practices, accounting techniques, but you can identify only three, right? So out of all these concepts, you can identify three and you can write. Now you need to mention in the write up, these are the concepts, these are the practices I'm going to choose in my synopsis writing, and then explain how each concept practice is applied or can be specifically applied. Sometimes these practices have already applied in your organization, or sometimes it's not the case. So in that case, how can you apply, right? So that's why it says how each concept practice is applied, currently applying, or can be specifically applied in your workplace with examples. So with examples, you can mention how you can apply these concepts in your organization. Third one, possible challenges and recommendations, that is approximately 200 words. So discuss any challenges faced or anticipated challenges. So I told you, you can have these practices already in your organization. If that is the case, what are the challenges you faced? Or else, if these practices are not yet implemented in your organization, if you are going to implement, what are the anticipated challenges you might face, right? It can be future days as well. In implementing the cost accounting concepts, practices you have identified. And then if you have identified the challenges, past challenges or the possible challenges, propose strategies to overcome these challenges. So what are the recommendations? What are the strategies you can recommend to overcome these challenges? So this is how it goes. There are three sections: introduction, and then you identify the concepts, and then its application, and finally the challenges and the recommendations, right? So now the assignment guidelines, I would say, like common guidelines, approximately 750. Now, when I say approximately 750, it can be 10% lower than or higher than this, exceed this 750 count. And the font is Times New Roman and font size 12, and line spacing 1.5, margin 1 inch on all sides. Document format, it should be a PDF, right? PDF. And then, as we all move on with these technological aspects, we all know we have AI tools, right? So AI tools must not be used for content generation. Their use is permitted solely for minor language editing and refinement purposes. So we will, it's a very small task of checking whether any assignment is written in AI. So there are tools. So that's why please don't use AI tools. This is about your practical aspect. This is about learning. So you have gone through with this, with today's session, you have gone through 6 sessions, and then you sometimes you refreshed your memory, and no, sometimes you learn new things. So it's all about applying these techniques in your organization, not just a qualification purpose, I would say. So that's why do it critically, think about it critically, think about it logically, and then you can apply in your organization, right? So don't use AI tools at all. And one important thing, you are professionals, you are working in organizations, or you are potential employees, right? So that's why this is more related to industry aspects, like practical aspects, even though we talk about theories. So that's one important thing is, when you write a report as a professional, as an employee working in an organization, make sure it looks nice. That's very important. We read the content later. First we see the assignment, first we see the report submitted by anyone. So in that case, font sizes and these lines, margins, alignments, font types, those things matter a lot actually. So that is important. So make sure you adhere to these common guidelines as well. And then how do you submit? The assignment must be submitted to this email address. I think you have this email address. This is the email address CMA is using to send you the materials, links, and all. So make sure you submit this assignment to this email. And the submission deadline on or before 11:59 p.m. on 23rd August 2025. So you have time, right? Today is 9th, and then 12th. You can do a good work, and then you can submit. And I'm sorry to say late submissions will not be accepted. And very important thing, please mention your name clearly when renaming the PDF. Now, when you're submitting, just don't submit uh, synopsis on short course on cost accounting for professional effectiveness or what. You need to mention your name. So we couldn't ask you to mention your CMA number because there are some non-CMA members as well joining this course. So mention your name, maybe your full name. That is easy for us to understand the or identify the submission, right? Please mention it. Remember that, very important. Otherwise, we can't trace actually the submission. Right. So those are the guidelines. Do you have any concerns, any clarifications? You can ask.
Yeah, Natasha, maybe a stupid question, but why are we submitting this? What is the objective ultimately?
Yes. This is upon the submission of this assignment, we will be issuing the certificate of participation. Otherwise, that certificate will not be issued because to complete this course, you need to submit this assignment. That's what we discussed in the first session as well.
Okay, all right, thanks.
So that's important question, I would say. I didn't mention it. Like to get the certificate of participation, the certificate of completion, I would say, you need to submit this assignment. That's important.
Do we get a kind of a feedback on our submission, like
Not
review?
really. Not really. But we'll see how it goes. I'll talk about this matter with CMA.
Okay.
Any clarifications? Any other issues? All clear, right? Apparently, yes. Right. So with that, we are moving to today's lesson. Give me a second. Right. Okay. So today's lesson is all about standard costing. Right. Uh, Let me share the chapter as well. That would be easy for you. Chapter in the sense I'm using Drury's book. Okay, I hope you received the chapter. That is the recommended reading, and that is very important. Like compared to the slides, there are limitations of preparing slides, but very comprehensive explanations are given in this chapter. So I will show you. I have highlighted. Actually, I have highlighted some important content and then I shared. So I will show you the recommended reading as well. We'll continue the discussion in that case. Right. Okay. So, standard costing, actually, navigating with standard costing here, we are talking about two different things, not different things, two related things, standard costing and then the variance analysis, right? So, we will discuss standard costing part first. And another important aspect coming to standard costing is the variance analysis, right? So, these are the session objectives. And now, my question is, what is a standard? What is a standard, right? Now we are talking about standard costing. So my first question is, what is a standard? Do you have any idea? Now I'm not referring to accounting standards, right? This is not about accounting standards. What is meant by a standard? A common definition? Yes. Yeah. Uh, Predefined guideline. Yes. A standard can be something predefined, maybe based on your past experience. Maybe based on your past experience, a predefined guide. A standard can be like that. Yes. Any other definitions? Now, if you apply this standard definition to management accounting, cost and management accounting, what is that? A standard in cost and management accounting. Let's say, as an example, I will show you. Now, let's say in our organization, we are manufacturing a product called product X. Product X. Now, when we are manufacturing this product X, let's say we are talking about a large scale manufacturing company, right? Large scale manufacturing company. We are making thousands of products. So we have been doing this production over last 10 years. So that means we have experience as well. We know how things are going. Now, when producing this product X, we need to have, what are the elements we need to have? We need to have direct materials, let's say. We need to have direct labor. Let's say we need to have direct other, I'm not mentioning, so direct other is also there. Or we need to have manufacturing overheads. Likewise, we need these elements when producing this product X. Now, how can we decide the cost? How can we decide the cost? Let's say we have not started production for this year. We have not started the production, but now with the past experience, with the previous information, now we can think about or determine the cost. How can we do it? Let's say to produce product X, we need 2 kilograms of this particular material. Let's say we are using only one raw material type, so we need 2 kilograms of that direct material. And with the past experience, we know 1 kilogram would be 100 rupees. 1 kilogram would be 100 rupees. So with the past experience, we know in an efficient environment, let's say without any abnormal losses, abnormal inefficiencies and all, we know roughly we need 2 kilograms. And then 1 kilogram would be 100 rupees with the past experience. And then how much is the cost in that case? 100 multiplied by 2. 100 multiplied by 2, 200. What about the direct labor cost? Let's say we know roughly we need 3 hours. With the past experience, roughly we need 3 hours to manufacture this product X. And as per the past experience, we know we have paid, let's say, rupees 50 per hour for our employees, right? So in that case, what's the cost? 150. 3 multiplied by 3 hours multiplied by 50, 150. Now, manufacturing overheads. How can we decide the manufacturing overhead? Using what? That we discussed in the third session. How can we decide the manufacturing overhead? Using what? Yes, these are budgeted figures anyway. What is the specific rate we say? What is the specific rate we calculate based on the budgeted figures? Yes, machine hours or man hours. That's how it goes. Yes, budgeted machine hours or man hours. What is the rate we use? Can you remember overhead absorption rate? The rate we calculate, as you have correctly mentioned, based on the budgeted figures, budgeted man hours, budgeted machine hours, yes, estimated production units. So can you remember the calculation of overhead absorption rate? You take the budgeted cost, budgeted overhead cost, divided by the budgeted allocation base. So budgeted allocation base would be maybe budgeted machine hours, maybe budgeted man hours, maybe budgeted production number of production units, right? So in that case, you take manufacturing overhead. Uh, we need not five. We need 3 hours again. We need 3 hours of labor cost, and then OAR, overhead absorption rate, is 10 rupees. So this is how this 10 rupees, not 100. This 10 we calculated based on OAR, overhead absorption rate, right? We do it usually for the manufacturing companies. So in that case, what is the cost of manufacturing overhead? 30 rupees. 30 rupees. So direct material, with the quantities, with the prices, we arrive at the cost. Direct labor, the number of hours we need and the rate of hour, like hourly rates, we arrived at the cost. And then using overhead absorption rates, we arrived at the cost of manufacturing overhead. So how much is the total manufacturing cost of this product X? 380 rupees. 380 rupees. What is this? What is this? This 380 rupees is what? That is the total manufacturing cost per unit. That's correct. But exactly, this is the standard cost. This is the standard cost of manufacturing product X. So think about your organization. Think about your organization. Do you use standard cost? Like, do you have a standard cost of manufacturing a product? If you are working in a manufacturing company, it can be a service company as well, service providing company as well. Do you have a standard cost? Like, with the past experience, with your knowledge about the industry, with your knowledge about the organization, you know the quantities required. And you know the prices as well, not the exact price, I would say, but the general price. And then you know the number of hours with the experience. It's not a big deal to get the number of hours. So likewise, you have standards set for the quantities or the usage. You have standards set for the prices as well. So in that case, using these predetermined quantities, predetermined prices, you can arrive at the standard cost. So basically, when you make decisions in this organization, you know, okay, 380 would be the standard cost of product X. So how much is the standard material cost of product X? How much is the standard material cost of product X? What do you think? Standard material cost of product X. Standard material cost would be 200 rupees because this is the material cost. What about standard labor cost? 150. How much is the standard manufacturing overhead cost of product X? 30 rupees. Likewise, you calculate 380 as the total standard cost of the product. So you have elements, as you can see: standard material cost, standard labor cost, standard manufacturing overhead cost, right? And another thing, now can you calculate a standard cost of a product like this if your products are always customized? Can you calculate a standard like this, a standard cost like this, if your product, let's say you are having a specific product in your organization, if that product is always customized? Can you do it? Customized in the sense, based on the customer's requirement, you are doing so many changes. The processes you are using, the materials you are using, the quantities you are using for that particular product manufacturing process would be different from customer to customer. Yes. So let's say if it is a manufacturing process with different processes, and the quantities are different, raw materials are different, the usages are different. Let's say 2 kilograms, 1.5 kilograms, 1.45 kilograms. Likewise, different quantities are used in different levels, right? In different situations, and then the labor hours are different. You can't exactly say the manufacturing overhead like for that product you can say, but not for all the products. It's the same product, it is customized. So in that case, standard costing calculation is challenging, or it is not practical. So one important thing you need to remember when you are learning standard costing, now I think you can see the recommended reading. This is the recommended reading text I have shared with you now. This is important. Read this. Standard costs are predetermined cost. That you know. Standard costs are predetermined cost. I determined manufacturing cost, standard manufacturing cost of product X using my predetermined quantities and predetermined prices. They are target costs that should be incurred under efficient operating conditions. Let's say if we are working efficiently, this would be the cost. Let's say when I'm taking 2 kilograms of direct material, I have not considered the abnormal inefficiencies, negligences done by the employees and all, right? But have I considered the normal losses? Another important thing. Have I considered the normal losses? Normal loss means what? Can you make normal loss zero? I think Dr. Numan explained you those process costing lesson. When you were learning process costing, you had two different losses, normal loss and abnormal loss. So what do you think about normal loss? Can you eliminate normal loss? Can you make normal loss zero? No, you can't, right? You can't eliminate normal loss. Anyway, those losses we are, and it's very usually it's very normal, usual losses. You can't eliminate normal loss. Can you eliminate abnormal losses? Can you eliminate abnormal losses? If you work efficiently, productively, yes, possible. It's possible. Can, right? So you can't avoid normal losses, but you can avoid abnormal losses. So my question is, before explaining this, uh, the other one I was explaining previously, another question coming: can we, should we include normal losses into the standard cost? When we are calculating the standard cost, should we consider the normal losses as well? What do you think? When I say 2 kilograms per unit, 2 kilograms per unit, should we include the normal losses as well? Yes, we should. So remember, when you are calculating standard, it should not be the perfect scenario. It would be the efficient operating condition. In an efficient, normal operating condition without those abnormal situations, right? What is the cost? What is the usage? So remember, normal losses are also included in the standard cost. Remember. So they are not as budgeted cost. Another very important thing. Standard cost and the budgeted cost. Now it looks the same. Budgeted means we are talking future, we are estimating, budgeting numbers. But it says they are not the same as budgeted cost. So what is the difference between budgeted cost and the standard cost? Any idea? What is the difference between budgeted cost and the standard cost? Any idea? Difference between budgeted cost and the standard cost. It looks like the same, right? It talks about the future, predetermined and all. Is it a difficult question? Now yes, it's like this. A budget relates to an entire activity or operation. Budget is about an entire activity or operation, right? Yes, exactly. That is correct. That answer is correct. It says, Manjula says, budget is prepared after discussing or deciding the standard. See, a budget relates to an entire activity operation. A standard presents the same information on a per unit basis. That's the difference. Standard is all about per unit basis, but the budget talks about the entire activity or the operation. So a standard therefore provides cost expectations per unit of activity, and budget provides the cost expectation for the total activity. That's the difference. So standard cost is all about per unit, but the budget is about the total activity, whole process, whole operation. Let's say this example. If the budget output for a product is 10,000 units and the standard cost is 3 rupees, let's take 3 rupees, 3 rupees per unit, budgeted cost will be 30,000. Are you clear? Budget. So the to calculate the budgeted value, calculate the budgeted cost, you need to have the standard first. That's how you do it. So standard comes first. Standard is all about per unit. And then based on that, you calculate, multiply with numbers and tell this is the budgeted cost. So are you clear with that one? A very important thing because you have learned budgeting as well as now you are learning standard costing. So always standard costing is all about per unit values, right? Okay. So that is one important thing. Okay. Now I'm moving to the point I was discussing actually. Standard costing is more suited to an organization whose activities consist of a series of common or repetitive operations where the input required to produce each unit of output can be specified. That's what I was talking about actually. Now, if it is a very customized product, that means always there's no one particular way of doing it. Based on the customer's requirement, we manufacture it. Let's say in that case, so when you are doing such a production, that means the operations, activities you are using for that product manufacturing is not common because it is unique for different orders, and that operation is not repetitive as well because we are doing customized products, we are doing different products. So in that case, setting standards would be difficult, setting standards would be impractical. So that's why it says this standard costing system can be effectively used where whose activities consist of series of common activities we are going to use should be common and should be repetitive. For the previous batch also we use the same thing, and then for this batch also we are using the same thing, repetitive operations. So it is therefore relevant in manufacturing companies since the processes involved are often of a repetitive nature. Think about a manufacturing company. So its processes are common and processes are getting repeated. Then only we can calculate a standard cost there, right? With the information availability. So standard costing procedures can also be applied in service industries as well, such as units with banks. Now, we were talking about manufacturing entities. That's true, garment manufacturing, food processing, and all. But when it comes to service providing also, we can take banks like a standard, repetitive, and also using common processes. What are the examples before I explain? What are the examples you can take? A very repetitive and very using common processes. In a bank, it's there in the text also. Without looking at the text, can you give me the examples? What are the what are the processes we can calculate the standard cost? The processes in that whole process should be repetitive and then common. Exactly. So personal loan application process, it says the same thing. Loan application processing. So number check processing, the processes, the tasks we do under that item, under that process is the are common. It's common for all check processing. All the tasks are common for all loan application processing. And then those are repetitive as well. For the application number one, same processes were conducted. For application number 2, same processes are conducted, right? So it's a general loan application process kind of thing. That is important. But the important thing is well-defined input-output relationships. Let's say how many kilograms we need for this particular unit. There should be a direct relationship. It should be well-established relationship. If not, you can't calculate, you can practically use standard costing, right? Direct, well-defined input-output relationships should be there. So look at this example. This makes sense. In fast food restaurants, such as Burger King, the standard input required to produce a single hamburger can be specified. So those item ingredients are standardized. How many? Oh, what is the kilo, not kilogram? What is the quantity? Quantity of grams or in any other packets or anything, right? So the quantity is specified. It is predetermined and it is a standard. And the Burger King knows exactly, okay, how much would be the price for this as well. For one item or for one unit or 1 kilogram or 1 gram, for the measurement scale, they know the price as well. So this case, it is therefore possible to specify the standard input required for a given output of hamburger, because there's a physical relationship between ingredients such as meat, buns. So it needs a bun. That is one bun, and that is standard. It needs meat. They know the portion, grams included in that meat portion. So that is standard. That is very easy. So there are input, output, well established relationships in that case, right? So this is how you do it. If you do not have this well defined input output relationship, you won't be able to calculate standard costing. That means you won't be able to practice this standard costing. Are you clear in that concept? That is very, very important. Okay. So that's why it says standard costing cannot, however, be applied to activities of a non-repetitive nature. If those processes are very unique, there's no repetition, those processes are not common and all, then you won't be able to calculate the standard cost. You will be able to calculate standard cost, but you won't be able to practice that standard costing system, right? You won't be able to have that system, standard costing system. That's the important aspect, right? So are you clear in that concept? Think about organization. First of all, share your experience, uh, whether you are working in an organization where standard cost can be applied or not. Think about it. Think about in that way. Think about your production. Think about your services you are producing, providing. Are you working in an organization where standard costs can be applied? What do you think? What is your experience? Think about the criteria we need. No experience to share? We have been applying, but due to recent cost fluctuations, standards have been exactly. That's important. That we can discuss actually. We can set the standards, right? We can set the standards, but due to the price changes, always standards get revised. That's true. That's part of the standard costing system, revising the standards. That's true, right? Any experience, any other organizations? Like when I say like an organization where we cannot use standard costing system, we can't exactly say this organization or this industry cannot do it, right? It based on the nature of the operations you are conducting. If in your organization somehow created the relationship between inputs and outputs, If you know it, quantities and all, then you can apply. If you can't, then no, then you can't apply standard costing system because that relationship cannot be easily understood. Input output relationship, right?
Natasha, I have a small
Yes.
query. Now, any organization which is run for profit, I'm not talking about NGOs, right?
Okay.
Run for profit,
Hmm.
it should be able to cost their product. If they cannot cost their product, then they can't run the operation profitably, in the sense they're running blind.
Yeah.
So if they are to cost the product, they should be able to cost their input, and that would be their standard cost. So
Ah,
actually, honestly, I can't think of organizations which cannot do costing or arrive at a standard cost.
yeah. The thing is, I will answer that question. It's not about calculating the cost. It's about maintaining that relationship for a long period in the system. Now, let's take one example where we sell unique products. Let's say a wedding dress manufacturing company or wedding dress sewing company, like customized, right? Fully customized based on customers' requirement. Wedding gowns are made, right? In that case, cost can be calculated. That is true. But from product to product, costing would be different. From product to product, specific job costing is there. Specific job costing. So for that job, you calculate the cost. But that cannot be applied for the second order. It is a second, it's a different thing. So in those organizations, standard costing system cannot be maintained. But obviously, as you mentioned, we can calculate the cost. But that is not the standard costing system. Standard costing system always for every product in Burger King, each and every single hamburger has the same quantity, same price. So very standard product. But if you are having a unique product, you can calculate the cost. That's a different thing. But that's not the standard costing system. Are you clear now?
Yeah, now at Burger King, for instance, for every item which is in the menu, there is a recipe.
Hmm.
And for that recipe, they would do a costing, right? Like say there is a bun and there is a patty, let's say beef patty or chicken patty or whatever, and then they will put certain amount of grams of, let's say, tomato or whatever, right? And then the sauce, ketchup, whatever they put, everything is in the recipe.
Yeah.
Now, well, there is a bit different because the people can come and order only what is on the menu. Nobody can order what is outside the menu.
Exactly.
But if it's a dressmaker, even the dressmaker will know the material cost.
Hmm.
Dressmaker will know the labor cost.
Mm-hmm.
And yeah,
It,
I understand what you're saying. If it's of a repetitive nature, yeah,
the product would be different.
yeah,
Number of hours we need to make that dress would be different from order
yeah,
to order.
yeah. Okay, yeah, right. Thanks.
No, do you get the point? Like the thing is, some organizations have standard products, as in Burger King. Some organizations do not have the standardized product; those are customized. So, are we clear on that point first?
Yes,
Yes. So when we have standard products, that means all the processes we are going to use, like in a Burger King, the process is very common processes are there. The same thing get repeated for each and every hamburger. They are getting the bun, they are cutting it into two slices and then putting this and then closing it, putting cheese and all, likewise. But think about a wedding dress making company. They are from one wedding dress to another wedding dress based on the customer's requirement, whether to use pearls or whether to use a long veil or fishtail or not. Likewise, the product is different based on the complexity, number of hours they need to make that dress would be different. The fabric would be different. If they are using a long tail for the gown, and then the number of meters of fabric would be different. So quantities we can't exactly say. Prices would be different. So in that organization as a whole, standard costing system cannot be implemented because they have unique orders, unique products. From job to job, they need to calculate and then add their markup and then sell, right? Job to job. Not all the products are similar. But in Burger King, hamburgers are the same, standard product, standard processes, similar operations, getting repeated. So the cost would be same for all the hamburgers, right? And then the prices would be the same. So in that hamburger, like Burger King, they can establish standard costing system. But in wedding gown making company, they can't use it because the orders are getting very different, very unique products. Is that
Okay.
clear
Yeah,
now?
understood. Yeah.
Yes, okay. So that's how it goes. The thing is, when you use standard costing system, you will be valuing your products. You will be costing your products. You will be costing your inventories based on the standard cost. That's the next point I have. When you have standard costing system, you are not going after your actual price for each and every product. You are costing your products. You are costing your inventory based on your standard cost. That is applicable. That is actually acceptable, right? But in wedding gown making, dressmaking, there you can't go after a standard cost. Let's say they are going after a standard cost. Let's say they say for material, this is the cost. This is the number of meters, quantity. But that would be different from dress to dress, wedding gown to gown. So in that case, they can't use standard cost. They will have to go with the actual prices, actual cost. But when you use standard costing system, let's say Burger King, they are not going after the actual cost of each and every hamburger. They use the standard cost. At the end of the period, after calculating the total actual cost and the total standard cost, they make some adjustments in the P&L. That is the rough scenario we have. Is that clear? So standard costing system means when you have that predetermined cost for the products, they do the accounting based on the standard costing, not the actual cost of each hamburger. But if it is a unique product, you will have to go with the actual cost. You don't have a standard cost, you have to go with the actual cost. So standard costing system, when you do it with the standard cost, at the end of the day, at the end of the period, you get the total actual cost, right? Total meat cost, total bun cost and all. So you compare what is the standard cost I have recorded, what is the actual cost. Based on the difference, you make some adjustments in the P&L, right? So that's the reason, that's the difference, actual costing and standard costing system. Is that clear now? Any doubts? It's good that you have doubts.
Yeah, Natasha, another question following up from that. Now, with all the standard costs, ultimately, let's say we are looking at the variance analysis. We are doing the variance analysis with our monthly accounts, right? Where we compare against the budget, say the raw material budget, the actual raw material consumed by department or whichever process, we look at the variance. Then when we then the we will be able to identify the variance. For instance, let's say um, making wedding gowns, right? So we have made a very non-standard product, and we will have a record, and we'll be able to identify the reason for that variance. Or we have used a material which is slow moving or something like that, or which has been previously written off, and we reuse it, and then the raw material will be having a very favorable variance. So that's the whole idea in finding out how that variance took place. So ultimately, at the end, it's with the monthly accounts, compare against the budget, that you will analyze to see what has gone wrong. Am I correct in saying that?
Yeah, let me correct you. Now, when it comes to standard costing, there's a
Yeah.
separate way of calculating variance analysis. I'll be discussing those formulas and all. But
Yeah.
when you compare your standard cost with just the budgeted cost, you won't get that real variance, I would say, right? So sometimes I will explain these when I'm talking about variance analysis. So
Okay.
different material cost, for labor cost, manufacturing overhead cost, for then how what about the price differences, what about the quantity differences. Likewise, different categories, we have different formulas, and then we calculate the variances. As you correctly mentioned, that variance analysis is done to identify whether there's a favorable variance or an adverse variance, as we thought, and then what are the reasons. So that is their variance analysis part. But that variances will not be directly linked to P&L. But what happened is, when you calculate the standard cost for products, and then when you have the actual cost at the end, not the budgeted, actual, actual cost at the end of the period, then when you have a difference, you apply it to the P&L. But for the variance analysis, as you asked, we are not specifically comparing it with the budget. We have more logical amounts going to calculate. Let's say not the budgeted figure as a total, but we are calculating a different value. I will explain the different values when we are calculating the variance analysis. Then you will understand, not just the budgeted figure. We are reshaping it, redefining the values, and then we compare with the standard value. Is that clear? I will explain those variance analysis formulas when I go to that point. Is that okay?
Yeah, okay, thanks.
Okay, so that's good. So those are the things. Standard costing, those are predetermined. Anyway, now you understand it. And then to set standard costing systems, always you need to have common and repetitive operations in the organization. Right. So let me go back to the slides now. Right. So when it comes to standard costing, there are different definitions given. I will just read one. Standard cost is the planned unit cost of a product, uh, component or service produced in a period. So remember, budget is about predetermined cost, estimated cost of a process or operation or total activity. But standard costing is all about one unit per unit. Okay, that's the difference. And then operation of a standard costing system. So I told you we are talking about a standard costing system. That means if we can establish standard costing system in an organization. So first one is setting standards for each operation and calculating the standard cost. That would be the first step. We are calculating standard cost for each operation. Let's say, as per example, product X, we calculate standard material cost. We calculate standard labor cost. We calculate manufacturing overhead. Likewise, for each element, we calculate the standard cost. Based on what? How do we calculate standard material cost? How do we calculate standard material cost? Based on the standard price and based on the standard quantity. Price multiplied by quantity would be the cost. So we get the cost, we get the prices, and we get the quantities, and then we calculate the cost. And what is the next step? Comparing actual performance with the standard performance. Comparing actual performance with the standard performance. Here, remember, this is not the budgeted performance or anything, right? This is not budgeted or anything. We are talking about the actual performance. We compare actual performance with the standard performance. That means standard, again, standard is per unit. Budget is standard per unit multiplied by the quantity. Budget is about the total activity. Standard is about the per unit, unit per. In that case, there's no point of calculating or comparing standard with another budget. We calculate or we compare standard cost with the actual cost. That's why we say comparing actual performance with the standard product performance. So are you clear with that point? We compare the standard with the actual. Because at the end, standard has become the budgeted amount. Because standard is per unit, budgeted is total units, the whole operation. So you compare actual with the standard. So after that, Analyzing and reporting variances. Now, when you compare your standard cost with the actual cost, there can be differences, variances. So you analyzing and reporting variances arising from the difference between actual and standard performance, and ultimately investigating significant variances and taking appropriate actions. This is how you do in a standard costing system. So basically, you compare with the actual performance. That's what I wanted to highlight. Is that clear? Are you clear? If there are any clarifications, you can ask. Right. Okay. Now this is a bill of material. Like when you set the standards, right? When you set the standards, when you identify what is the price for this material, and then what is the quantity of materials required for this production. Likewise, we can use the bill of material in manufacturing entities. So these manufacturing entities, let's say this for this PO, for this buyer, for this style, order quantity is 5,000, right? For this order, they have prepared a bill of material with all the items they need for that order, what is the consumption, if we purchase extra purchase percentage, and then the quantity, and then the unit price, rate, unit price again, and the amount. Likewise, I'm not reading the bill of material, you can refer to it. So this is one source. We can get the quantities, we can get the prices to get calculate the standards, right? So different sources can be there. Most of the time we use our past experience, what has happened in the previous years, based on the experience, and always there can be market changes. So looking at the market changes and the past experience, we set the standards. This is the standard quantity required to manufacture this product. This is the standard price of that material. Likewise, quantities and prices we set. And then we have different types of standards as well. Different types. Basic standards, ideal standards, and attainable standards. What do you mean by basic standards? They are kept unaltered over a long period of time and may be out of date. Basic standards. You set the standard, but you are not changing the standard. You are not adjusting altering the standard. Is that good? It is not, because there can be so many changes in the market happening outside. So in that case, you need to reflect those changes in the standard, basic standard, we would say. Most of the time out of date, outdated. And then ideal standard, ideal, perfect. What do you mean by ideal standards? Based on the most favorable operating conditions. Most favorable operating condition means no wastage, no inefficiencies, no idle time, no breakdowns. The machines are working perfectly, employees are working with 100% productivity, no wastage happening, no normal losses, no abnormal losses whatsoever. So that is ideal. Can that be real in the manufacturing, in a manufacturing organization, in any organization? No, right? Ideal standards cannot be there, but we can calculate as well ideal standards. If we are working perfectly fine, what would be the cost? What would be the cost? What would be the quantity required? And then attainable standards, attainable, based on efficient. Those are efficient, but not perfect operating conditions. What is the difference between efficient and not being perfect? That means some allowance is made for wastage. So we know that there will be normal losses. So we have to make allowances for normal losses as well. We have to keep a margin for the normal losses. Sometimes there can be inefficiencies as well. That's normal. There can be machine back breakdowns as well, right? Those are normal. So efficient, but having allowed for those small wastages, normal losses, inefficiencies, and machine breakdowns. So in an efficient working condition, those things can be there. So attainable standards, when you set attainable standards, those standards consider these wastages and inefficiencies. So that is, I think, the attainable standards are the good standards we need to use in an organization. If we use basic standards which are unaltered for a long period and out of date, that won't give us the actual scenario, actual numbers. If we go after ideal standards, what would be the case? It would, if we go after ideal cases, always the actual cost would be higher than the ideal cost, ideal standard cost, because always the cost is higher, because we are talking about ideal situation, whereas the practical actual situation would be different. There can be losses, there can be wastages and all. So that's why we have to go after attainable standards. Remember, we have to go after attainable standards. So the point is not just learning about the three types of standards. When you are setting standards in your organization, make sure you set standards for the efficient working condition, not for the perfect working condition. If you go after perfect working condition, always your standard cost would be lower, whereas actual cost would be higher. So there's no point of calculating variances monthly, right? So go after attainable, efficient working conditions, right? That is a learning point there. And then standard cost card. I would say nowadays we don't have standard cost card in a physical, like hard copies are not available. Most of these things are computerized, right? Computerized. So standard cost card we can like this, like this. It's a very simple thing. As I showed you in the Excel, this is kind of a very simple standard cost card. We mention the item, we mention the material types and all, we mention the usages, quantities, and we mention the prices, so we can calculate the cost likewise, right? So here standard cost card for product alpha, direct material, there are two types, A and B. The quantities are there, the prices are there, and the cost. Direct labor also, there are two grades, right? Number of hours are different, and then the rates are different for grade 1 and grade 2, the cost. And then manufacturing overhead, number of hours, rate, and the cost. This is how you calculate the total standard cost. So this is to show when you are manufacturing alpha, let's say when you are manufacturing hamburgers in Burger King, this is the direct material quantity. These are the direct labor hours. This is the manufacturing overhead rates. Based on the standard usages, this would be the cost. So likewise, you can have this 150 and 75 all together. If we take 225, this is the standard material cost. This is 100 plus 120 standard labor cost. Here 200 would be standard manufacturing overhead cost. 645 in total would be the standard cost. Likewise, you set standards for different components. Right. So this one activity we have, just look at this activity. I'm not taking so much of time for this. You need to prepare the standard cost card of product beta, right? Just go through it for 1 minute, and then try to reflect that in your like take a piece of paper, or maybe just prepare the standard cost card. What we actually want is not actually preparing the standard cost card here. Think about your organization. Reflect what you are doing. Whether you can set standards for direct materials, set standards for direct labor, set standards for manufacturing overhead. Can you specifically say for our products, this is the quantity we need? Or do you have these variances coming? Sometimes your organization might have different products. For some products, you can set the standard cost, but for some, you can't. There can be situations like that. Just take few minutes. It's about a product beta. So you have materials, you have two types, X and Y. You have labor, grade 1 and grade 2. And then you have manufacturing overhead. So I'm just showing you the answer, and I have included the answer in your slide as well. I'm not wasting time there. Likewise, you can take direct materials, direct labor, manufacturing overheads, and then get the types. And then you can put the quantities, 3 kilograms, 4 kilograms, set in the price. This is the standard quantity. This is the standard price. Then calculate the cost. So here, this is the standard labor hours per unit, and this is the per unit labor hour rate, right? 150. Likewise, manufacturing overhead, the overhead absorption rate. See, manufacturing overhead is absorbed to the product based on labor hours. That means you need to calculate the OAR, overhead absorption rate. You calculate it, you multiply it by the number of hours, and then sorry, and then you calculate the cost. This is the total cost. So I'm not explaining it. You can read it and you can refer to the answer. In that case, you can prepare a standard cost like that. Right. So I'm going after variances. Actually, it will take some time. There are different variances we can calculate. Now, this is the important part, I would say. Now, standard costing system is kind of a control mechanism. It's kind of a control mechanism. Why? We set the standards and then we compare our standards with the actual performance. After that, we comparing after getting the variances. It can be good variances or bad variances. That means positive, negative, favorable, unfavorable, right? So based on the variance, we analyze, we understand what has happened, what is the reason for this variance, kind of thing. That is kind of a control mechanism. In organizations, when you have the standard set and when you compare with the actual, always you can identify the reason what has gone wrong, maybe with the production department, maybe with the procurement department, maybe with any other department, right? Marketing department, whatever the department, we can identify what is the issue, what is the source. Likewise, so it's a it's a good control mechanism, calculating variances and identifying the variances. Right. So comparing the actual figures with the standard figures and finding the reasons for off standard product performances would be the basic understanding for variance analysis. So you can see purpose to assist managers in controlling performance evaluation planning. Let's say when we compare this year's standard cost and the actual cost and last year's standard cost and the actual cost, always the actual cost is higher than the standard cost. What does that mean? Maybe the standard is not correct. Maybe the standard is outdated now. As one of you mentioned, standards should be updated with the market. 5 years back, we thought price per kilogram is 100. Now it's 3 times higher than the prior price. So in that case, we have to update the standard. So likewise, planning and decision making. So those are the purposes of calculating the variances, right? So now when you calculate these variances, right, there can be favorable and unfavorable variances. Let's say uh, in terms of cost, in terms of a cost, any cost, material cost or labor cost or anything, standard cost is 500. Standard cost is 500. Actual cost is 800. Tell me whether this is a favorable variance or unfavorable variance. This is a favorable variance or unfavorable variance.
Natasha, probably we have to first identify whether there is a sales volume variance, because the variance of 800 could be there is a sales increase in volume. If
This is the unit
Okay,
unit cost.
yeah, right. It is adverse variance of 300.
Right. Now, if I say standard cost, not the unit cost, we have used 2 kilograms, and then the price is 100, and then the cost is 200 in that case. Actual, also 2 kilograms we have used of this material, and the price is 120. In that case, the total material cost is 240. In that case, is this a favorable variance or unfavorable variance? First of all, favorable, this cost, material cost. This is the material cost. Here, 200 is the standard cost. Actual 240 is the actual cost. Favorable variance or unfavorable? Exactly. Unfavorable variance. Due to what? Due to the quantity used or due to the prices? Due to the quantity used or due to the prices? Exactly, due to the prices, right? Quantities are the same. Quantities are the same. This unfavorable variance is because of the price change. Price has increased. We thought it's 100 rupees, but the actual cost is 120. In that case, this unfavorable variance is due to the prices. If this is the case, what happens? Again, unfavorable variance because actual cost is higher than the standard cost. Because of what? Quantity variance. Because of the quantity variance. Sometimes, so my point is, sometimes there can be variances because of the price changes or because of the volume changes, the quantity changes. We call it usage changes. Let's say this is the case. What about now? Oh, sorry. What about now? Altogether, material cost, if we just look at the material cost, standard cost, and the actual cost, favorable or unfavorable? Just look at the material cost in total, favorable or unfavorable. Your standard cost is 200, whereas your actual cost is 175. That means favorable, right? A favorable variance. A favorable variance. But look at the usage. Is it favorable or unfavorable? Look at the usage. It is favorable or unfavorable. You can't calculate a variance there because you don't have the cost and all, but just look at the usage quantities and tell me, is it a favorable situation or unfavorable situation? Quantities. Quantity wise, it is unfavorable, right? We had a standard of 2 kilograms, whereas we have actually used 2.5 kilograms. So this is unfavorable. Then even though we have unfavorable variance in terms of quantity, we ended up having a favorable variance of 25 rupees. Why is that? Even though we had a quantity unfavorable variance, unfavorable situation in terms of quantity, we have an overall favorable one. What is the reason? Because in terms of price, we have a favorable situation. We have a favorable situation. So the pricing impact is greater than the quantity impact, isn't it? Pricing impact, that is 30 rupees per kilogram change. We thought the standard price would be 100, whereas the actual price is only 70 rupees. It's a huge amount, 30 rupees per kilogram. So even though we have used more quantity in the production, we had a positive favorable price variance. Because of that, that unfavorable situation of the quantity is like hidden. It is hidden in the positive price variance. That's why we have ended up with a favorable material cost variance. So what I'm going to say is there can be variances in terms of the cost, but we don't know whether it is due to usage variance or price variance or both, or there are positive, negative, both inside this material cost variance. That we need to figure out. Why? Now, when you take usage, when you take the quantities used, which department is responsible for this? Quantities used, standard quantity and the actual quantity. Which department is responsible for this exactly? Production department is responsible for this usage because they are the people who are using the quantities. Which department is responsible for this price changes? Purchasing. Exactly, the procurement department, they are the people who are purchasing the materials. So if it is a quantity variance, negative quantity variance, production department should be responsible. If it is a negative price variance, purchasing department should be responsible. That's why by looking at the total material cost variance, we can't exactly find who's the culprit, who's the responsible party. We need to go in detail whether it is due to a price change, whether it is due to a quantity change, or both changes, or there are some positive, negative mixed. Sometimes like this negative variance coming from the production department is not seen very clearly because there's a huge positive price variance there. So we can't look from the material cost variance and get decisions. We have to go deep and find what is the responsible department, whether it is a usage variance, whether it is a price variance. So that is why we calculate several variances using several formulas. So do you get the meaning? In your organizations also, you can't just make decisions because comparing the standard cost and the actual cost. You have to go deep, you analyze deep why. The usage, whether it is due to a usage, whether it is due to a price, right? So this is the case. That's why we are calculating so many variances. Let me go back. Now here, we are going to calculate cost variances. We are going to, yes, yes, cost variance. I will answer that question. Now, when it comes to cost variances, we have direct material cost. As I took an example, that is direct material cost. Direct material cost variances, direct labor cost variances, and we have manufacturing overheads. No, we have the overheads. We have overheads, and we can, for this variance analysis purpose, we are analyzing it as two categories: total variable overhead cost variance and total fixed overhead cost variance. Variable and fixed, both. We are calculating variable overhead cost separately and fixed overhead cost separately. Remember, right? So that is for formula purposes, calculation purposes. And with that, we are moving to total direct material cost variance. Direct material cost variance, right? Okay, let's have the break first, and then we'll finish these variances after the break, because if I start here, it will take some time. So we'll have a 10 minutes break and then start with the calculations. Please take a piece of paper with not Excel actually, that is easy to calculate these things. To have the numbers, we are writing formulas and then identify the formulas and then we are getting these numbers. So get ready with that as well. So we'll have a break and then we'll start at 10:05. 10:05. Okay. Right. Let's get started with the variances. I hope you all are there. Right. So the first one is material cost variance. We are talking about material cost, labor cost, variable manufacturing overhead, and fixed manufacturing overhead. Those are the four types of variances. So in that case, we are first taking direct material cost variance. As you can see, cost of materials is decided by two basic factors that we discussed, price and the quantity, price multiplied by quantity. In that case, yes, in that case, so we can calculate total material cost variance first, as we discussed in the previous example, and then material price variance and material usage variance. Usage means the quantity. What is the variance? Because of the usage variances, likewise. So we'll look at the first variance. When and the first thing, the important thing is when you learn the first variance and when you identify the logic behind it, you can calculate all other variances. That is the beauty of variance analysis. So just remember these important points. If you are just calculating, just jot down these important points. This is the example. We'll use this example and calculate the material cost variances. So there are three variances: material cost variance, coming under that material price variance and material usage variance. Right. So it says the material standard of Lanka PLC for the product A is as follows: 5 kilograms. What is this? The standard quantity. Based on their previous experience, previous operations, they have identified, okay, 5 kilograms of this material is required to produce product A in a perfect working condition or in an efficient working condition. Efficient working condition. And then rupees 4, that means the standard price per kilogram is 4 rupees, whereas the material cost standard is 20 rupees. Material cost standard is 20 rupees. And then actual production is 1000 units. 1000 units they have manufactured. And then actual material cost. How much is the actual cost? They have used, in manufacturing 1000 units, they have used 5500 kilograms in total. And the cost was 3 rupees and 50 cents per kilogram. So you can see the numbers. Price 3 rupees and 50 cents per kilogram. Right. In that case, now you need to calculate total material cost variance. Total material cost variance. First of all, you identify the total variance. How do you calculate the total variance? Right? You need to understand this as well. Total material cost variance equals, you take standard material cost for the actual production. Now the production is already done. Production has already happened. What is the actual production of this example? 1000 units. 1000 units. So you get what is the standard material cost for the actual production. If you use the standard quantity, if you have purchased the quantities as per the standard price, what should have been the cost for the actual production of 1000 units? That is the standard material cost for the actual production. And you compare it with the actual material cost. Actual material cost is like for in manufacturing 1000 units, how many kilograms they have actually used and what was the actual price per kilogram, actual material cost. So you compare always standard material cost for the actual production. We don't change 1000 units because it is the output. We can't change that 1000 units. When manufacturing 1000 units, if you have used the standard quantity, if you have used the standard prices, what should be the cost? What should be the cost? Right, do it, try, give it a try. You understand it logically and then you do it. Standard material cost for the actual production. How much is the standard material cost for the actual production? How do you calculate? Standard material cost for actual production. Actual production is 1000 units. When you multiply it by the standards, okay, we'll see. Now, the actual cost, actual production is 1000 units, isn't it? Actual production is 1000 units. If we use the standard quantity when manufacturing 1000 units, it should be 5 kilograms. That is the standard quantity. And the price is rupees 4. That is the standard price. So the standard cost is 20 rupees per unit. Standard cost is 20 rupees per unit. So the standard material cost, standard material cost for the actual production would be 1000 multiplied by 20, 20,000, right? As you have correctly mentioned, standard material cost for the actual production would be 20,000. We could have spent, we should have spent 20,000 rupees for this 1000 units. But how much is the actual cost? How much is the actual cost? How do you calculate the actual cost? They have used 5,500. They have used 5,500 kilograms, 5,500 kilograms at a price of 3 rupees and 50 cents. That means 19,250 is the actual cost. Now compare. Standard cost is, standard material cost is, for the actual production is 20,000, whereas your actual cost is only 19,250. Variance is, the difference is 750. Is it favorable or unfavorable? As per the standards, if you have produced, you have to spend 20,000, whereas you have actually spent only 19,250. So overall, you have a favorable variance of 750, 750. I hope that is clear, right? That is the favorable variance of 750. Above favorable 750 variance was occurred due to two main reasons. What are the two main reasons? Because of the prices and because of the usages, right? Now calculate, now keep that in your mind, 750 is the total cost variance which is favorable, which is favorable. Now material price variance. What is the variance because of the price change? What is the variance that has occurred because of the price change? Previously, it was the overall cost variance. We don't know whether this 750 is because of the price or the usage. Now the price variance. How do you calculate? For that, you take, definitely, when you calculate, when you compare the prices, you need to take the two prices now, standard price and the actual price. Standard price and the actual price. You multiply it by actual quantity of materials purchased. Remember, actual quantity of materials purchased, because that quantity has been already purchased. That quantity is already purchased. So you take the quantity actually purchased and you get the difference, standard price and the actual price. Can I have the material price variance? What is the actual quantity of materials purchased? Actually, they have used 5,500 kilograms. Actually, they have used 5,500 kilograms. So you multiply it by the difference between standard price and the actual price. What is the standard price? 4 rupees per kilogram. What is the actual price? 3 rupees and 50 cents per kilogram, right? So we take 5,500, that is the actual quantity you have purchased, multiplied by the difference between standard price is 4, actual price is 3 rupees and 50 cents. That means per kilogram, there's a 50 cents per kilogram. There's a 50 cents difference. Favorable or unfavorable? Standard is 4, actually 3 rupees and 50. Favorable. Favorable total variance is 2750. 2750 favorable variance. Right? Favorable variance. Exactly. Your answer is correct. Now tell me, what are the possible variances for this material price variance? Favorable price variance. Why do we have a favorable price variance? What are the possible reasons? Exactly. What are the possible reasons? Yes, maybe we have negotiated well. The standard price is 4, whereas we have taken the prices in, we have taken 3 rupees and 50 cents. So maybe we have negotiated with the supplier. That's a good one. Or maybe we have received a discount. If that's why there's a price, a favorable price change. We have received a discount. Or else what? USD rates because of the exchange rate differences. Correct? Those are positives, no? What about the negative reason? For this favorable price variance, to get a favorable price variance, exactly, substandard raw materials. Low quality raw materials, let's say we have set 4 rupees as the standard because we need this particular quality material. But whereas we have gone for inferior material, let's say lower quality material at a low price, cheaper price. So in that case, this is because of this low quality material as well. This can be a reason. So you need to think why, the what is the reason for this. Likewise, now you know when you calculate material price variance, you just can't stop your investigation just because you have a favorable variance. You need to analyze further why there's a favorable variance. Let's say you are always getting a favorable variance like this. Past year, previous year, you always had a favorable variance, whereas your actual is 3 rupees and 50 cents or 3 rupees and 45 cents over there. Your standard is 4. Now, what can be the reason? Over the past years, it was the reason. Always there's a favorable price variance, and then that because of the standard is higher, actually is 3 rupees and 50 cents or 3 rupees and 45 cents likewise. I'm talking about this material price, not our price, material price. So can't it be the reason 4 rupees standard is wrong? The standard of 4 rupees, standard price is wrong, can be wrong. Maybe the standard is wrong. Standard is outdated now. Maybe we have set the standard when the Sri Lanka was having that economic crisis, the climax of economic crisis. Still, we are having that crisis, but the prices were way too higher 2 to 3 years back, isn't it? 1 year or 2 years back. So at that time, we set the standard, but now the prices have like gradually dropped up to some extent. Now, when you go with the actual prices, always we get 3 rupees and 50 cents or 3 rupees and 45 cents. I don't say this is the only reason. A possible reason can be the standard is wrong now. The standard is, price standard is outdated now. So that's my example for previous question, I would say. We can sometimes identify standard errors as well. Standard errors like this. Maybe we have come to an agreement with the supplier to sell these sell these materials at this price based on one of our agreements, mutual agreements. Likewise, there can be different reasons. What are the negative reasons? What are the causes for an unfavorable variance? Now, this is a favorable variance in this situation. What are the reasons for an unfavorable variance? Let's say prices are higher, maybe because of the inflation, right? Maybe because of the inflation, maybe because we have gone for a, it can be some kind of a fraud as well, right? Based on the company policy, we have to take three quotations and we have to go with the lowest cost possible. But it's not the case. Purchasing department manager has a friend who is selling the same material, and then he has given the price order for the order for that supplier, the friend. So the prices are higher, right? That can be the case. Sometimes the inflation. Sometimes uh, you have gone for a high quality material at that time because of a reason. Likewise, you can analyze what is the reason for this decision, what is the reason for this variance through the purchasing department, right? Yes, supplier becomes the monopoly and market price maker because we had a standard supplier, registered supplier. We were purchasing all these materials from that party over a long period of time. But that supplier has become a price maker, very good price maker, because he is having a monopoly now. Now we can't do negotiations or discounts or anything. Previously, we were taking discounts and all. His or her prices were cheaper, but now it's not the case. So maybe we will have to change the supplier. So those are the recommendations. Maybe we analyze and go deep and deep, and then we find okay, maybe we have to change it. Government has imposed a tax. VAT rate has increased to 18%. Because of that, the prices are higher. So in that case, do we have to change our standard as well? What do you think? Yes, if there are constant changes happening, now we can't go with the previous old standards. We will have to revise our standards as well, right? So those are the possible reasons. You can list down so many reasons for both favorable and unfavorable material price variances. So we have discussed those things. Right, that is about price variance. No, what about the usage variance? Now we don't know whether this material cost variance is due to price or usage or both. Now, after calculating the price variance, we knew there's a 2,750 favorable variance coming from the prices because the actual price is lower than the standard. What about the usage? Do we have to think about the usage as well? How do we calculate that variance? First thing, we compare actual quantity used. That is true, no? Actual quantity used with the standard quantity required for actual production. Remember again, actual production to produce 1,000 units, what should be the standard quantity? If we have used the standard quantity of 5 kilograms per unit, what should be the requirement? But what was the actual purchased quantity, right? You compare it and you multiply it by the standard price. You multiply it by the standard price. Why is that? I want a reason for that. Why are you taking standard price? You could have used actual price now. Why are you taking the standard price? What is the reason? What is the reason for taking the standard price instead of the actual price? Exactly. You are not taking the actual price because you have to eliminate the pricing impact from the usage variance. You are calculating only the usage variance. If you mix up with the price variance here with the actual price, your answer would be different. Wrong. So in order to reflect only the usage variance, you take the standard price, not the actual price. Right? That is the reason. So logically think about it, not just the formula. Okay, right. Can I have the answer? What is the standard quantity required for actual production? Your actual production is 1,000 units, whereas if I'm correct, your standard quantity per unit was 5 kilograms. 5 kilograms, yes. 5 kilograms. So the standard quantity required for actual production would be 5,000 kilograms, 5,000 kilograms. Whereas your actual quantity used is 5,500 kilograms. 5,500 kilograms. Let's see. Yes, 5,500. That means you have 500 kilograms used extra extra. What is the standard price? 4 rupees. So when you multiply 500 by 4 rupees, 2000, favorable or unfavorable, you have used material uh, exceeding your standard quantity, standard requirement. That means unfavorable. Unfavorable. So mention, I think you have noted. Now, when you are writing the variances, you always mention whether it is a favorable or unfavorable. Otherwise, that doesn't make any sense. So you have to mention whether it is favorable or unfavorable. At least 2000 unfavorable because you have excess. You have used excess materials, right? What are the reasons? What are the reasons for this unfavorable variance? Possible causes for this unfavorable variance? Why you have used extra materials? What are the possible reasons? Production reject inefficiencies in the production. That I can take. Inefficiencies in production. There are abnormal losses. Employees are not trained well. They are using so many of waste. They are doing so many of wastages. Negligence in using handling materials, right? So sometimes there can be low quality materials used. Because of that, the standard level of the product is not coming because you are using the substandard materials. Because of that, you have to use more. You have to use more, right? That maybe you can link with the price variance as well. If you can remember prices, we had 2750 favorable variance. Maybe because you have gone for a cheaper, not cheaper, a cheaper material, but a low quality material. Because of that low quality material, now you are ended up having material usage negative variances because you have to use more and more materials to get the right quality for the product. Likewise, we can link. That cannot be the reason exactly. Likewise, we can link the reasons. What are the possible causes for a favorable usage variance? Let's say we have a favorable one. Standard quantity is 5000, but let's say we have used only 4500 kilograms. Maybe the uh, material quality is good. Yes, maybe the formula change. Let's say we have changed the formula for the production, the ratio, the mix we have changed. In that case, don't we have to change the standard as well? Do we have to continue with the previous standard? Yes, technology changes, those changes can be there. So in that case, if you intentionally change the formulas, change the mixes, change the technology, change the production methods and all, you have to revise the standards as well. No point of keeping the old standards if you are changing these important things. So remember, revising standards is a must, right? So those are the possible reasons you can have, right? Now, another important thing. Sorry. Before moving to direct labor cost variance, now just analyze. You can just write down material cost variance. Material cost variance. Material cost variance was 750 favorable, if I'm not mistaken. 750 favorable. What was your material price variance? What was your material price variance? If I'm not mistaken, 2750 again favorable. What is your material usage variance? What's your material usage variance? That is 2000 unfavorable. See, 2000 unfavorable. Do you see any connection between these three variances? It's something like this. You can divide material cost variance into two, price variance and usage variance. Your price 2750, that is a positive one, favorable, and you had usage variance 2000, which is unfavorable. What is the net impact? What's the net impact of these two? 750 favorable. See, that's why material cost variance become 750 favorable. Net impact. So you can always see whether your variances are tallying like this. Now, if you have out of these three variances, if you have two variances, you can calculate the next one. Other one, let's say you have calculated price variance and you have the cost variance as well. No need to use formulas and calculate the usage variance. Definitely, you can take if it is 750 favorable. If it is 2700 and 2750 favorable, usage variance should be 2000 unfavorable. Net impact. Likewise, when you have, if you have two, you can always calculate the third one. Remember that as well. That would be important. Okay, so do you have any issues? Are you having any clarifications for the material cost variance and then material price and usage variance? If you have any doubts, you can ask. Yes, we're not talking about multi-products here because of the time limitations and all, but yeah, multi-products, when we have multi-products, we have to calculate the product mix and then we have to calculate. Any issues? No? Any issues or any clarifications? Yes, that's why I'm sharing the chapter actually. In that chapter, everything is there. Okay, hope there are no concerns. Let's move on, but I'm not so sure whether I'll be able to finish all these standards. We see, I have shared the material. That's why I have shared the materials and I have not deleted the answers from these slides as well. I have shared all the formulas and the answers too. So if you have a basic understanding about the basic variances, you can calculate, you can understand the other variances like variable and fixed overhead variances likewise after reading, right? That's why, that's the whole point. So we'll discuss these fundamentals, then it would be easy for you to understand the rest. If I don't have enough time, right? So let's move on to the labor cost variance. Labor cost variance. Labor cost variance is also the same thing, right? So it's like total, the labor standard of Lanka PLC for product A is as follows. That is 2 hours and 5 rupees. 2 hours means the standard labor hours and 5 rupees would be the standard labor cost per hour rate. So in that case, labor standard is 10 rupees. Labor standard is 10 rupees. Actual production is 1000 units, that doesn't change. And look at the actual labor cost. They have actually used 1900 hours and the rate is 5 rupees and 50 cents per hour. That is the actual rate. Quickly calculate total direct labor cost variance. Total direct labor cost variance. Now look at the formula first. Previously, now refresh your memory. Total direct material cost variance. What was the formula? You took the actual material cost and you compared it with the standard material cost for actual production. If you are producing the actual production with the standard cost, what would be the cost? Standard material cost for actual production. Now go to direct labor cost variance. There also it's the same. You compare the actual labor cost with standard labor cost for actual production. It's the same again. So only the word changes here. Likewise, if you understand one, you can understand the rest. Standard labor cost for actual production. Quickly calculate and tell me the variance. So here, if you are manufacturing 1,000 units, that is your actual production. If you have used your standard hours as the 2 hours, and if you have paid your standard wage rate of 5 rupees per hour, that means 10 rupees per unit, 1,000 multiplied by 10, 10,000 would be the standard labor cost for actual production, 10,000. Whereas your actual labor cost, that means 1,900 hours you have used, the cost is 5 rupees and 50 cents per hour. So in that case, the cost is this amount correct? 1,900 multiplied by 5 rupees and 50 cents. Yes, 10,450. That is the actual labor cost. So in that case, what's the variance? 10,000 minus 10,450. Standard cost is 10,000, whereas you have spent more additional 450. That becomes unfavorable. Now we are calculating. Now previously, when it comes to materials, material cost variance because of material prices and material usages. Direct labor cost variance because of, again, two reasons, the same logic, but the words are different. Because we don't say labor price variance, we say labor rate variance. We don't say labor usage variance, I would say. We use labor efficiency variance. So only the name changes, right? Price becomes rate, usage becomes efficiency. So labor rate variance, that is like material price variance. Calculate it. So how do you do it? Same logic. Since it is the rate variance, you compare the standard wage rate with the actual wage rate and you multiply it by actual number of labor hours worked. For the materials, you took actual materials purchased, actual quantity of materials purchased. Here you are taking actual number of labor hours worked. Calculate it. Actual number of hours worked. How many hours? 1,900. 1,900 was the actual quantity you have used. Whereas your standard wage rate is 5 rupees. Actual wage rate is 5 rupees and 50 cents. So you can see by looking at the prices, there's a problem with the prices. Your standard is 5, but whereas you have paid 5 rupees and 50 cents extra for each hour. That means unfavorable variance of 950. 950, correct. 950, unfavorable variance. Quickly tell me, what are the possible causes for this favorable labor rate variance? No, not the favorable, sorry, unfavorable. What are the possible causes for this unfavorable rate variance? Maybe what? Maybe the usage of skilled labor, which is expensive. Sometimes you have used skilled labor. Skilled labor are expensive. Skilled labor hours are expensive. So in that case, you have used skilled labor. That's why you had to pay more per hour. And then actual bonus overtime expenses are higher than the planned. You were planning bonuses, overtime expenses, this rate, but the actual was higher than that. Maybe the unions have renegotiated with you and they have increased their prices or the rates. What are the possible reasons for favorable variance? Maybe the usage of unskilled labor, which is less expensive. You were planning to use trained labor hours, but you have used unskilled labor hours. Or the actual bonus overtime expenses are less than the plan, right? Or you have negotiated, it's very unlikely, you have negotiated with the unions and taken lower rates. That is not a good reason, I would say, right? That doesn't happen, no. Likewise, so these are the reasons. What is the other variance? Labor efficiency variance. Labor efficiency variance. Instead of material usage variance, you calculate labor efficiency. Again, what is the logic behind labor efficiency? You take actual labor hours worked, actual labor hours worked and the standard labor hour requirement for actual production. In order to produce 1000 units, what is the standard labor hour requirement? And you multiply the difference by, again, not the actual labor hour rate, standard wage rate. Standard wage rate. Why are you taking standard wage rate? Because you want to eliminate the effect coming from the price changes. That's why you take the standard wage rate. Quickly tell me the answer. So the hour, standard labor hours, 2 hours. So 2 hours multiplied by 1000 units. 1000 units is the actual quantity, actual production. So if you have manufactured your production, actual production using the standard hours, you should have used 2000 hours. Whereas you have used only 1900 hours. You have used only 1900 hours. What is the standard rate? 5 hours. So in that case, you can say your standard hours for actual production is 2000, whereas you have used only 1900. It is favorable, 500 rupees favorable. So in terms of usage, in terms of efficiency, you have a favorable variance. What are the reasons? Again, maybe favorable variances can be due to use of skilled labor. Since you have used skilled labor, they are working efficiently. They are having less number of wastages, less hours of low hours of wastage hours. Idle time is lower. In that case, usage is lower. Use of superior quality materials. When you have materials, good quality materials, you can do the production very efficiently. You don't have to wait for machine breakdowns, inefficiencies, and all. Introduction of the new equipment or tools. When you have new equipment, labor hour requirement would be lower because you can easily finish your work within a shorter period of time. Successful training programs. You have used training programs to improve their skills. So now they are skilled, they are working efficiently. So you are using less number of hours. Those are the favorable variance reasons. On the other hand, you can find the unfavorable labor variances. Likewise, unskilled labor you have used inferior quality when you have used low quality materials in the production flow. Employees are struggling, laborers are struggling. Maybe as an example, if you are using low quality material fabric for production, t-shirt manufacturing or any garment manufacturing, it takes much time to complete a t-shirt because it's difficult to do the production with low quality materials, right? And then failure to maintain machinery in proper condition. That means when there are so many machine breakdowns, you have idle time. That means you can't work efficiently. You can't finish your targets within the given time. So it needs more hours to complete. Training programs you have not conducted, or the conducted training programs are unsuccessful. Those are the possible reasons. Right. Now again, quickly draw this down. Identify the variances. Now this is, I will take the same thing. So labor cost variance, I take labor rate variance, and then I take labor efficiency variance. Labor cost variance is 450 unfavorable. Labor rate variance, because of the rates, labor rate variance is 950 unfavorable. In that case, how much should be the labor efficiency variance? How much should be the labor efficiency variance? If you have 950 unfavorable here, and then you have a net impact of 450 unfavorable, definitely this should be 500 favorable. We'll see whether efficiency variance is 500 favorable. Yes, this is how you do it, right? Okay, now I'm moving to variable cost analysis. Variable overhead variances, as I explained you, there are now when it comes to manufacturing overheads, you have two types: variable overheads and fixed overhead. Sometimes those are variable, sometimes direct material cost can be, indirect material cost can be there, right? Sometimes those are variable, but whereas we can have fixed variable, fixed overhead like factory rent, that would be fixed, and depreciation, sometimes it could be fixed based on the number of machines and all, likewise fixed overhead. So we are using two different, variable and fixed. Now first we calculate total variable overhead cost variance, like we calculated for materials and labor, and there are two sub standards coming, variances coming: variable overhead expenditure variance because of the prices, and then variable overhead efficiency variances because of the usage. Same thing, again the names are different, right? You need to remember these points. Remember these points. Below details are related to Lanka PLC. Budgeted variable overhead cost of product A is budgeted variable overhead cost. Remember, now we are talking about variables, overheads. So they are budgeting the overheads. What is the cost of product A is 8,400 per week. Remember, 8,400 per week budgeted cost. Budgeted production units are 1,200 per week, 1,200 units per week. And the budgeted hours to be worked in a week is 40 hours. Okay, in 1 week, there are 40 hours budgeted. Actual production was 1,155 units in the last week. 1155 units in the last week, actual production. Actual variable overhead cost, the actual cost is given, actual cost is 8,350, and the actual hours were 40 hours. Right, these are the information. Even I wrote the same details, right? Okay, now to calculate, first we are calculating total variable overhead cost variance. What is the variance coming out of this variable overheads? Total variable overhead cost variance equals, you calculate standard variable overhead cost charged to the production. Standard variable overhead cost charged to the production, and you compare it with the actual variable overhead cost. So the actual variable overhead cost is there in the question. Actual variable overhead cost is 8,350. Now it's just a matter of calculating this standard variable overhead cost charged to the production. Remember, we are charging overhead cost based on what? Overhead absorption rates. So how can we calculate this? That's why we have sub formulas given. I have given these formulas as well. Standard variable overhead cost charged to the production. How are we going to calculate? First of all, you take, how are we going to charge the overheads? Using OAR. Variable overhead absorption rate per hour, that is absorption rate, multiplied by the standard hours for the actual production. For the actual production of 1,155 units, what is the standard hours required? That is how you absorb. And then, do you have problems how you calculate the variable overhead absorption rate? So this is the sub formula for this. Variable overhead absorption rate, you can calculate, you take the budgeted variable overhead cost divided by budgeted hours that we have discussed. This is how you calculate the first part. How do you calculate this standard hours for the actual production? Standard hours we need for the actual production. We take the actual production, 1,155 units, and you multiply it by the standard hours per unit. Standard hours per unit. Right. So using these sub formulas, that's why I told you I have given the sub formulas as well. Just a matter of calculating these two. Can you give it a try quickly? How do you calculate? How do you calculate the variable overhead absorption rate? How much is your budgeted variable overhead cost in the question? Budgeted variable overhead. Budgeted variable overhead cost of product A is 8,400 units. 8,000, not units, rupees value, 8,400, cost is 8,400, budgeted cost. Right. How many units? Budgeted production units are 1,200 per unit, isn't it? 1,200. So in that case, 8,400 divided by 1,200. Sorry, I have made a mistake, right? That's why I was wondering, why did I do? Variable overhead cost, we are dividing by the budgeted hours. Sorry, but not budgeted units, budgeted hours. How many budgeted hours are there? Because we are talking about variable absorption rate per hour, not per unit. So you have to take the hours. How do you calculate the hours? Yes. So I'll show you the answers. Right, likewise. Here, now variable absorption rate, you are taking the budgeted variable overhead cost, that is 8,400. Budgeted hours for the week, it's there, right? Budgeted hours for the week, 40 hours. So it says 40 hours. So in that case, you are dividing 8,400, that is your budgeted cost. Among the budgeted hours 40, 210 rupees per hour, that is your overhead absorption rate, variable overhead absorption rate, 210. You have calculated it. So that's how you take this 240 into that here. When you calculate the standard variable cost charge to the production 210, you bring it here. Now the next part is you need to calculate. Now we calculated this standard hours for the actual production. How do you calculate that? Standard hour actual production. There are different ways you can calculate it actually. Calculate and say, just give it a try. I'm not showing the answer. You don't see your answer as well. Standard hours for the actual production. These are the information. Now the thing is that direct standard hours per unit is not directly given in this question. That's the issue. You need to calculate it. Standard hours required for 1 unit, it's not given because we are not talking about standard hours required for the actual production. Our actual production is 1,155. But we don't know what is the standard hours for the actual production. That's what you need to calculate. Right? It's not directly given here. Standard hours. Now I would say how many hours you need for the, how many hours are there for the budgeted week? Budgeted hours for the week, 40. How many you are going to manufacture? How many units you are going to manufacture in that week using these 40 hours? 1,200. 1,200 units. In that case, per unit, how many hours you need? 40 divided by 1,200, that is 0.03 as a mathematical calculation. So if that is the number of hours you need to manufacture 1 unit, to manufacture the 1,155 units, how many hours you need? 38 and 38.5 hours. Are you clear? There are different ways you can calculate, right? Different ways. 38.5. 38.5 exactly. You have taken 38.5. So in that case, you can take standard variable cost charged to the production. First, you take the previously calculated absorption rate 210. You take it there, and then standard hours for the actual production. That means 40 hours you need to manufacture 1200 units. So divided by 1200, and then you multiply it back by 1155, you get 38.5. 38.5 hours. That is the standard hours for the actual production. So when you absorb your variable overhead absorption cost, variable overhead cost using the OAR, you have charged 8,085 rupees for the actual production, right? You have charged 8,085 rupees. So you having calculated that, you take the total variable cost variance, you take the standard variable overhead cost charged for the production 8,085. You compare with the actual variable overhead cost that is given 8,350. Yes, actual variable overhead cost is 8,350. So, is it favorable or unfavorable? Standard cost is 8,085, whereas the actual is 8,350. Definitely unfavorable. 265 unfavorable. So it's just a matter of following the formulas, but I would say not following the formulas, just understanding it. So since it would be much difficult to get this standard variable overhead cost charge to the production at once. That's why I gave you step-by-step formulas. So when you're practicing, when you're applying these things in the organization, you can implement. Actually, you don't want to remember all these formulas, I would say. All these are computerized using systems, using Excel sheets, you can calculate. So once you set the formulas and then you link all these computations, just a matter of changing the numbers. So that's why I have given you the variables, formulas. You can use these more small formulas and then come up with the final answer, right? Not like you are memorizing all these formulas, right? So that is standard variable overhead cost variance. Now there are two types, no? Variable overhead expenditure variance because of the prices, variable overhead efficiency variance because of the usage. Look at how we calculate this one. Variable overhead expenditure. How can we calculate that? We have budgeted flexed variable overhead cost for the actual hours and then actual variable cost incurred. So actual variable overhead cost, anyway, we know that, right? We know the cost. Here, the answer is here, right? Variable overhead expenditure, actual variable overhead cost expenditure, we know that 8,350. The problem is how to calculate budgeted flexed variable overhead cost for the actual hours. See, I have given you in the working. This is the answer in the Excel where the formulas are written. I have given the formula here as well. Budgeted flexed variable overhead cost for the actual hours. How do we calculate it? You take the actual hours, it is flexed, it is changed, actual hours, and then you take variable overhead absorption rate per hour. Variable overhead absorption rate per hour. So we have calculated it 210. If you can remember, we calculated the OAR 210, whereas our actual hours, it's given as actual hours, we have used 40 hours. So we multiply it by 40, 8,400. That is the budgeted flexed variable overhead cost. Whereas the actual cost is 8,350. In that case, actual is lower than the standard, 50 favorable. 50 favorable. Likewise, this is the, I'm just going fast because our guest lecturer might join now. Right. So that is how you apply the numbers because you have already calculated. Now just a matter of applying the numbers here. Same thing, we are going with variable overhead efficiency variance because of the usage of hours. So that's why we take previously also, can you remember we took standard rate, standard price. Here also we take standard variable overhead rate, right? And you multiply it by the difference between actual hours used and then the standard hours for actual production. It's kind of labor efficiency variance. Labor efficiency variance very similar to this, right? So you calculate it. You take the standard variable overhead rate. We have already calculated it 210. This is our OAR. And then the actual hours 40 hours. 40 hours. This is in the question. How do we calculate the standard hours for actual production? We previously calculated it, right? Can you remember 40 hours per week? We divided it by the number of units, 1200, whereas we multiplied the answer by 1155. That was the actual hours, actual units, actual production. So standard hours for actual production, 38.5 hours. So by looking at the numbers, you can say actual hours are greater than the standard hours for the actual production. That is an unfavorable variance. So 315 unfavorable. This is how you calculate variable overhead efficiency. Remember, variable overhead efficiency is if you are using allocation base as direct labor hours, it is very similar to direct labor efficiency variance because the same answer would be there when you are analyzing the reasons, right? That is the answer for those. So we have discussed variable overhead cost variance there. Right. Uh, Give me a second. Right, we can take some few minutes. I'm just quickly explaining the other variable as well. Fixed overhead variance. Now we were talking about variable overhead variance. We are talking now about fixed overhead. Again, fixed overhead variance also. There are two types, main two types. Fixed overhead expenditure because of the prices. It can be factory rent likewise, fixed overhead, and then fixed overhead volume variance. Because of the production, what is the impact coming from the fixed overhead? So the formulas are there. I'm not explaining the formulas, right? So you can say standard fixed overhead cost charged to the production and then the actual fixed overhead. So if you take standard fixed overhead cost charged to the production, I have mentioned the formula for that. Standard fixed overhead, that is, you take the absorption rate and you multiply it by the standard hours for actual production. How do you calculate fixed overhead absorption rate? You take the budgeted cost divided by the budgeted hours. You know these budgeted rates. And then the standard hours for actual production, as we calculated previously, you take the standard hours for the unit and then you multiply by the actual production, right? It's the same concept, it's the same things, but the way we calculate and get the numbers would be different. So it's just a matter of getting the formulas correct for the first time and then using formulas you can read the numbers. So that is the fixed overhead cost variance. So for all these formulas I have given you the answers. You can go through these answers and self-study. And then fixed overhead expenditure because of the pricing differences, rate, the cost changes. You take the budgeted fixed overhead expenditure and you take the difference between actual fixed overhead expenditure. See, it's simple as that. There are no sub formulas for that. And then the second part, fixed overhead volume variance. Remember, this is a fixed overhead volume variance arise from actual production differing from the budgeted production. Remember, this volume variance comes from the production volume. So you take the standard fixed overhead rate. Again, we took standard material cost, we took standard labor rate, we took standard variable overhead rate. Here also we are taking standard fixed overhead rate because just to eliminate the pricing effect. and then we multiply it by the difference between standard hours for the actual production and the budgeted hours for the budgeted production. Because why are we taking here budgeted production and actual production? Because we are taking the volume difference, production volume difference. That's why actual and budgeted volumes are there. So that's how you calculate variance. I have given you the answers like this. Right. So if you have any questions, you can ask. I'm not explaining the rest of that was the plan actually to cover the cost standards and the variance analysis. I have given you, but right, I have given actually there are I have 60 slides. That's not achievable at all in this 2.5 hour session. So, but for your information, since I do not have another session to cover these things, I have included these things. So, you can read these sales variances. Now you have the fundamental understanding, right? How to set the standards, how to compare those standards with the actual performance, and how to identify the variances, identify the reasons for the variances, and investigate. So if you have that understanding, you can definitely read these slides for more information. And also you can read the chapter I shared. Most of the parts I have highlighted for your reference. So you can read them and get a good understanding about the variances, right? So try to implement when you are reading these standards, when you are reading these formulas and all, try to implement these, not trying to see whether you can implement first of all, because there are some conditions to be satisfied as we discussed. So think about your organization, nature of your production, whether we can set these standard costing systems and all. Okay, that's the ultimate learning point from these lessons. And I have given you one activity as well, and then all the answers are also available. So you can work on these answers, work on the question and check your answers likewise. Right. I'm waiting for Mr. Clean. I will check with him and then quickly come back. Uh, please stay. Meantime, since this is our last day of this short course, actually, uh, many of you like had clarifications, had issues. You asked so many questions. That is really nice. But only one of you actually talked. So that's sad. But anyway, you used the chat box with me, and I hope you clarified few of your clarifications at least. So being a short course, I can't cover everything, right? Both Nuance and myself can't cover all the aspects. We can discuss only the fundamentals, right? If we have time, of course, we can go in deep and calculate more, do more calculations, talk about more practical applications. But that's why to cover that aspect, we have invited industry experts, right? That's how we invited few, let's say four industry experts to this 6 days short course actually. So I hope you learned at least few things, or you refreshed your memory, because you have learned these things previously. Now it's just a matter of refreshing your knowledge and thinking about the new developments. So if you have any clarifications, you can ask, you can take this time, because yes, do you have any issues? Okay, so with that, we can start today's guest lecture session. Actually, we have invited our guest lecturer and he has joined the session by now. And I welcome Mr. Tirina Abbe Gunavardhana. Thank you very much, Mr. Tirina, for accepting our invitation and joining this session. So before starting, if I just give a brief introduction to Mr. Tirina, he's the head of operations at Keel's Food Products PLC and also the senior assistant vice president of John Keel's Holdings. He's a graduate from Sri Jayabhadanapur Accounting Department, having a first class BSc Accounting program. And then he has his MBA from University of West London with a distinction pass. And also he is a SEMA member and also an ACCA member and a certified TPM practitioner from the Institute of Lean Management as well. So having experience in the FMCG industry over 15 years in both finance and operations, I think he's one of the best persons to talk about the standard costing and all. So we talk about the basic theoretical understanding about the standard cost, and then you can ask or you can clarify any practical concerns, issues with regards to standard cost and listen to him. So thank you once again for joining us, and over to you, Mr. Tirita.
Okay, thanks, Natasha. Good morning, everyone. So I think my screen is visible for you all.
Yes.
Can you all see the PowerPoint?
Yes, Mr. Tirita.
Okay, so we'll start the session. So I think during the morning hours, you all would have received a good theoretical background on what's the standard cost and how are we basically using it in an organization. So before moving into the standard cost and its application in the real world, I just want to share a few things on the standard cost. So basically, when we are operating in an organization, especially in the FMCG categories, fast moving consumer goods, the standard cost is heavily in use. The reason why we use standard cost will be explained over the session, because up to now you have only the theoretical understanding on how to work out the standard cost and what is the basis for standard costing. But when it comes to the real world application, how are we making use of it? How are we basically use that in our day-to-day lives is what you all need to understand with a better clarity. So uh, in today's world, I think most of the organization, I would say almost 90-95% of the organizations are basically using ERP system, enterprise resource management system. And some of you would have been must be using the ERP system right now in your day-to-day operations. The well-known ERP systems are SAP, now SAP S4. Now we are moving, most of the companies in SAP now basically moving to SAP HANA 4. So there are certain upgradations which are happening. And apart from that, the Oracle is there. So those are the two main ERP systems which are being used worldwide. And apart from that, there are certain tailor-made systems as well. So when we are working in an ERP environment, we have to learn the basics of standard costings in order to do the financial part of it, especially when we are in a FMCG sector. I'm not saying it's only applicable to FMCG organizations, but even in the service organizations also, this standard costing can be applicable to a great extent, because the disadvantage we have in standard costing is it's a bit of a traditional costing system, but still it's being used in most of the updated ERP system, because though it is a traditional costing method, uh, basically there is nothing which can be replaced. So that is why we are using the standard costing in our all the day-to-day operations when it comes to this product costings, budgeting, planning, and all that. So let's move into the current today's session. So I'm basically supposed to give the practical application of standard costing. Where are we using this in our organization, and why are we using it? So let me take you to the points that I have highlighted. So starting off with budgeting, planning, and forecasting. I think some of you all would have done budgeting, planning in your organization, and some are very familiar with it. So when you are doing the budgetings and planning, even the forecast is, so whatever the terms that you call it. So basically, we are looking at our future. So in that kind of an exercise, this standing costing is heavily used. So we will go into the details when it comes to the each bullet points in the upcoming slides. Then the other one is the pricing. So which is one of the crucial decision that any organization has to make. So in whatever the decisions that we are making with regard to pricing, we are making use of the standard costing. The third one is the stock valuation. So we are having different valuations in our companies. There are certain valuation which are basically done in-house by the in-house finance team, and there are certain valuation which we use to get it done from an outsourced qualified valuation parties. So in stock valuation also we have to use in standard costing. I will explain when it comes to that particular point. The fourth one is the control. So standard costing give us the opportunity to control the organization. I will explain how we are going to control and what are the areas that we are controlling, and what is the importance of having standard costing to use as a tool when you are controlling an organization's performance. Then the fifth one is the continuous improvement. So all the organizations are not basically happy with their current status quo, because we all the organizations have to grow in their own. So when we are growing our organizations, when we are growing our businesses, we have to improve our operations continuously. So in order to accommodate that, this will give us a good guidance. So let me explain that also when it comes to that particular point. And the final one is the performance evaluation, which is another critical part of an organization. For that also, this standard costing will be very useful. So I think, so these are the 6 main points that I'm trying to cover during my uh, lecture in another 15 to 20 minutes time. So we'll
Enough.
go.
Sorry
Sure.
to interrupt you. I think we are still in the first slide. We can see the first slide.
Really? So I'm actually in the second slide.
Shall we reshare?
Yes. Give me a second.
All right.
Can you all see now?
Yeah, now we can see the second slide.
Okay. So these are the main 6 points that I have already discussed. So we are basically using the standard costing in practical terms in these 6 main areas. So apart from these 6 main areas, there are some other areas in an organization that we are using standard costing. But if we look at the big picture of an organization, so these are the main 6 areas that we can really talk about how we can use the standard costing. Are we clear up to that point? Shall I move forward, Natasha?
Yes, Mr. Taylor, you can.
Okay. So I think in the morning you would have learned about what is the standard cost and how do you define the standard costing. So as I told you before, this is a very traditional costing system, but still there's a validity. And when it comes to standard, so the word standard give us a kind of a understanding. Okay, so this is something that we need to basically follow, or that we need to basically use when you are doing the day-to-day operation. So standard is something called a guideline that is basically defined by the organization. So when it comes to this standard, there's no hard and fast rule called look here, this is the standard that you need to follow across all the businesses. So basically, when it comes to standard costing, the word standard can be defined by the company itself. So based on the business that you're operating, based on the experience that you'll have, based on the expertise that you'll have in the business, you can basically define what's the standard which is applicable for your company. But when you are defining the standard, that has to be a logical standard. I will explain that point as well. Uh, so basically, these are the predetermined parameters. So I'll take a small example. I'm basically taking it from a bakery industry. So in the screen, what you can see is a cake. So when you're in the bakery industry, so I just took a one particular example to make a 1 kilogram of cake. The flour requirement is 200 gram. So you must be wondering how you can make a 1 kilo by using 200 grams of flour. There are some of the ingredients also which is being used to do the manufacturing, but for the clarification purposes, I have only taken the flour requirement. So if you look
Oh,
at this,
I'm sorry again. I think we can see the second slide now. And this slide by
okay,
slide has a problem. Yes, now can see.
is it visible now?
It's visible.
Okay. So as I told you before, I'm just taking one example from the bakery industry. So here the example is to manufacture or to produce 1 kilo of a cake, the flour requirement is 200 grams. So I just took this particular example only for the clarification purposes. So here the standard is the material. So I think you would have discussed about the standard material cost, the material price variances and the usage variances in your theoretical part. So here the standard which is defined by the companies, you have to use 200 gram of flour to make a 1 kg of cake. And the second point that I have taken is the overhead. So basically, uh, we are setting the standard not only for the material that we are using, even for the overheads that we are using, we have to set the standard, because otherwise you can't basically get the maximum out of maximum benefit or the maximum yield out of the facilities that you have in an organization. So here you have your organization has defined the flour requirement is 200 gram for a 1 kg of cake, and when it comes to overhead part, that is the oven times, the baking time, that is also predefined. So in order to bake a batch of cakes, the baking time is 30 minutes. So I forgot to mention that batch is about 10 pieces of cake. So in order to bake 10 pieces of cake, the baking time is 30 minutes of the oven time. So those are the two variables that I have taken. This is for the understanding purposes. So we'll when I'm discussing the 6 main points that I have highlighted at the beginning, where we used standard costing, I will take this example to elaborate the applicability. So the first one is, as I told you before, the budgeting or the planning or the forecasting. So different organizations use different terms in order to uh, name it. So most of the companies have different budgeting cycles, different planning cycles, different forecasting cycles. So when it comes to the FMCG sector, fast moving consumer goods, in those companies, the manufacturing companies has to done at least one budget for an year, at least one planning session. There are certain companies which are having more than one planning cycles in their organization. So, for example, uh, in our John Keel's group, we do have two formal planning sessions applicable to all the organizations. So we are doing the annual budgeting, which is at the very beginning of the year before we start the financial year. We are doing the planning for the next financial year along with the 5-year plan projection. Then after 6 months is over in the financial year, we are doing another planning session called reforecasting. So we are basically evaluating the performance of the first 6 months against the actual against the uh, plans that we have done and do whatever the corrections or alteration for the next 6 months. So that is the that is called as a reforecast. And apart from that, on a monthly basis, we are having our monthly forecasting cycles, which is called as the best estimate for the month. So there are different budgeting cycles in an organization, which is defined by the organization itself. So moving into the standard cost application. So here, why we basically need the standard costing to do the budgeting. So the first point is uh, the purpose of having a budget in place is to give kind of a direction to your organization, because as you start the year, you have to know what are we heading. All the departments in an organization have to know what are our targets. So for example, if let's say if you are in this particular industry, so I have basically uh, take a target as selling, in this particular example, selling 1 million cakes per next year. So in simple terms, you know how we measure this profitability and all that. So profitability, so in the plan, the ultimate objective is to quantify your top line and the bottom line. Top line is your revenue, bottom line is your profitability. So in order to have an estimate, have an target for your revenue and for your bottom line, you have to have few other information as well. So basically revenue you work out by using the estimated selling quantity, selling price into, so selling quantity into the selling price that you have, that you're basically targeting to sell the product. Then you have the expenses. In that expenses, you are considering both the direct cost as well as the indirect overheads. So when it comes to direct overhead, this is where the standard cost is basically applied. You have to quantify your direct material cost as well as your direct overhead. So after factoring that, then you have to consider your indirect overheads as well. So once you get the net of all these things, you will get into the profitability that you are basically targeting for the next year. So in a particular example, your sales team has basically come up with an estimate of selling 1 million cakes in the next year. So that is your sales target, which has been already set. So by selling 1 million cakes in next year, what is the revenue that you are going to generate? What is the cost that you have to incur? What is the profitability that you can make out of this whole exercise? So this is what we are doing as a budget. Though it is seems to be a very simple exercise, when it comes to the real application, when you are doing the budgets in an organization, you have to follow a lot of steps. So let me explain it through a single example. So here, as I told you before, one cake requires 200 grams. So in order to do the in order to manufacture this 1 million cakes, what would be your material cost or the expenses that you need to incur for your material cost as well as for your overhead, so that you have to quantify. So it is very easy, as long as if you have a standard, if you have a predefined uh, formula, then you can easily work it out. So here I have taken the flour cost is 200 rupees. You need 200 grams of flour to prepare one cake, and plus you have a packaging cost of 10 rupees per cake box. So your total estimated cost per cake is 50 rupees. So this is the direct material cost. So when it comes to direct cost, it's basically it has two components. What is the first one is the material, direct material, and the other one is the direct overhead. So in this particular example, your total direct material cost of manufacturing a cake is 50 rupees. Then you have the overhead, which is the baking time, the oven time that we have considered in our example. So our uh, in our example, cost of running the oven or cost of running the particular equipment to bake the cake is 500 rupees per hour. And we have defined in our standard one batch is 10 cakes, and that particular batch requires 30 minutes. So you can work it out and see the total direct cost. The total direct overhead cost per cake is 25 rupees, because your hourly charge is 500 rupees and you are supposed to spend only half an hour. So that is why I divided by 2. Then per batch there are 10 cakes. So cost per batch, so the direct overhead per cake is 25 rupees. Now you have the total material cost, total direct cost, total direct overhead cost. So the summation of these two comes to about 75 rupees. Now you must be wondering why I have not considered the labor here. I haven't considered it before because of the clarification purposes. Yes, we have to consider other expenses as well, but for the clarification purposes, I just stick to the material cost and the uh, basically the direct overhead which is being used to manufacture this particular product. So the total cost is 75 rupees. So in order to sell, now you are planning to sell 1 million cakes in the next year, so in that case you have to incur about 75 million to manufacture this particular quantity. So in order to do this, you have to have 75 million with you to manufacture this required quantity. So now you can understand why are we using the standard costing in our budgeting purposes. So if we don't have the standard cost, if we do not know the standard cost per unit, what is the material usage, what is the material cost, what is the overhead usage, what is the cost of that overhead, if we don't have that visibility, you basically cannot work out your next year plan. So I think now you can understand what is the importance of using standard costing in our budgeting. Then I'm moving into the second one, which is also basically related to the first one. Natasha, I think my screen is visible for you all.
Yes.
Okay. So in this particular instance, which is the pricing decisions, which is also basically related to the previous one as well. So when you are doing the pricing decisions, it is critical to have the standard cost in place, because pricing is the most critical factor which determines our revenue. So when you are making a pricing decision, that has to be very sensitive and that has to be very thought that has to go into a very thoughtful process, because unless you fix your price correct, you won't get your estimated revenue. So let's see how that help us to do the pricing decision. Now in our previous example, I'm continuing with the same. So we are planning to sell 1 million cakes in our organization, and we have just quantified now the total cost of producing a cake is 75 rupees. Now it is up to us to decide what are we going to set, what are we going to set as our selling price. So when you are setting up the selling price, we need to consider different aspects. Now here I just took the gross profit margin that you are expecting. So usually in a manufacturing company, as long as if you can generate a gross profit of 30%, minimum of 25%, then you are done. So that is the basically a world class benchmark that we have in our FMCG sector. As long as if you are in 25%, then you are having a very decent uh, GP margin and you are basically operating in a very decent level. And if the GP margin is between 25 to 35%, any organization can survive without any issue. And if the JV margin is more than 35%, you are in a very healthy business. But at the same time, you have to be mindful of the competition. Now here, in our scenario, what I have used is we are expecting a GP of 25%. So our cost is 75. So in order to make a GP margin of 25%, you have to price it at 100. So if you don't have the standard cost calculation in place, and if your organization doesn't basically define your standard cost and standard cost is standard material usage, standard overhead usage, without having those information, you can't basically arrive at this particular selling price. So since we had a well defined standard cost in place, it is very much easy to first quantify the expense part of it, basically the cost that you need to manufacture the product. Then you are adding up a expected profit margin, then you are doing the pricing. So here you are going to price your cake as 100 rupees. So if this standard cost is not in place, if you are not basically familiar, or if you're not following the standard costing in your organization, basically you can't do the accurate pricing to earn a desired profit margin. So now you can very clearly see we have defined our selling price by targeting a GP margin of 25%. Why? Because you have a very well defined standard cost in place. So my last question here, you must be thinking, oh, okay, so just having a standard costing will help you to come up with a accurate pricing. So is that the question? Is that the correct way of defining it? No. When you are basically setting up a selling price, you are not only depending on your standard cost calculation, because you can do your own standard. As I mentioned at the beginning of the session, the standard can be defined by your organization based on your expertise. But when you are setting up the selling price, you are not basically relying only on the costing and the profitability data that you are doing in an spreadsheet. At the same time, you have to consider what is the competition. So you are trying to sell your product at 100 rupees, but what if in the market there can be certain cakes available at 85 rupees, 90 rupees, and even there can be certain cakes available at 125 rupees. So you have to look at the competition, and you are basically looking at what is the target market share, target market that you are going to cater this particular cake, whether you are going to cater the high end consumers, whether you are going to target the middle class consumer, or whether you are targeting the lower uh, lower I don't use the word the lower class, but the low end consumer segment where you need to penetrate the market. So based on those factors also we have to take the pricing decision. But fundamentally the having a standard costing will basically assist you to set your selling price. So that is how we are basically using the standard costing in our pricing decision. Then the third one is inventory valuation. So when it comes to this inventory valuation in our organization, there are different types of inventories. Okay, so I will just putting in the screen what are the different types of uh, inventories that you are maintaining in our organization. The raw material, the first one is the raw material. Whatever the raw material that you used in the manufacturing process, then you have the packing material, packaging material stocks. Then you have the semi-finished good, which is the work in progress, and the finished goods. So, and apart from that, there are certain consumable inventory, there can be engineering inventory, there can be a fixed asset inventory. So different types of inventories are there, but here we are just focusing on the the inventory which is basically used in our trading part of it. So that is the raw material, packing material, semi-finished goods, and the finished good. So here I have used two different colors. The raw material and the packing material is in black color. Why I have put it in black color is raw material and packing material, you know exactly what is the cost is. If you are buying, in this particular example, flour to prepare, so to manufacture your cake, you know what is the price that you are going to pay for the flour supply, which is given. Nothing to worry about it. Similarly, when you are buying the cake box from an outside supplier, you know what is the basically the price that you are going to pay for the supplier. So based on that price, you can easily value the stocks. But the question mark comes in when we are trying to value your semi-finished good and the finished good. So what is the basis that we can use to value the semi-finished good and the finished good? So semi-finished good is work in progress. Sometimes there can be cakes which are already baked but not yet packed, not yet put into a box. So that you can basically termed as a work in progress or the semi-finished good. So how at any given time, let's say by the end of financial year or by the end of your accounting period end, there can be certain inventories left. There can be semi-finished goods, there can be finished goods, similarly raw material and packaging material. So raw material and packaging material, as I mentioned before, you can use different inventory valuation method. I think you'd have learned those things. We have the first in first out, last in first out, first expiry first out, then weighted average. So there are different types of the moving average prices. So there are different bases of valuing those kind of straightforward inventories in an organization. But when it comes to semi-finished products and the finished products, which are basically created as part of your manufacturing process, you have to have a basis to value. So let's say as of the last date of the your accounting period, you are left with 100 pieces of cakes which are not basically packed. So you have not incurred the cost of box to pack that particular cake. So you can't basically put the cost of box also to the same 100,000 pieces and value the 100,000 pieces at the 75 rupees in our example, because the 10 rupee that you are supposed to spend on the packaging cost has not been incurred yet. So in order to value that, you have to take the cost as 65 rupees per semi-finished product. And if you are having, let's say, 200,000 cakes in your inventory as finished goods, then you can straight away take 75 rupees, because that is the total material cost plus the total direct overhead cost that you have already quantified. So since you have the standard costing in place, you know what the cost of this semi-finished good than the finished good. So it will make your lives easier to value the inventory. So if you don't have these two information, then you have to put an estimated figure, which can be something misleading, which can be not basically according to the actual result. So in order to value your finished goods and the semi-finished goods, you have to have the standard costing in place, which will enable you to do an accurate inventory valuation. Then the fourth one is the control. So you must be wondering, how are we going to control an organization by having a standard costing? So these, I think, out of the all aspects, I think these are the most important aspects of having a standard cost, and also you would have done certain calculation also with regard to this. So let me explain it. So what do you mean by controlling here? So when it comes to control, you must be thinking that you are basically chasing behind one person and look whether he is working according to the rules that we have set. No, that is not the case. So here, especially in an organization, in a manufacturing setup, you need to look at whether your operation is operating at 100% efficiency level. So if you are not operating at your 100% efficiency level, then there's a question in your whole process. In order to identify whether you are operating it at the optimum level, this standard costing helps you. I will explain how it happens. So in your initial theoretical calculation, you would have done certain variance calculations. Now in my example, you are supposed to use 200 grams of flour to make a 1 kg of cake. But end of the day, once the production is completed, you have noticed that you have not used 200 grams, but instead you have used 220 grams of flour to prepare a cake, to manufacture a cake. So 20 grams you have consumed more. So that you are basically quantifying as the material usage variance. You are supposed to use only 200 grams, whereas you have used 220 grams. So basically you have used 10% more than your expectation, your well-defined standard. So which is not good for the organization, because you are basically deviating from the set standard by 10%, and that is also quite substantial. So when it comes to this variance analysis, you can see, okay, what we have set is 200 grams, but the actual production has ended up with 220 grams. So there can be certain gaps in the system. There can be uh, certain lapses in your system, because when you are manufacturing a cake, you have to follow certain steps: adding water, mixing it better, and taking your dough correctly, and the mixing time. So all these factors will affect to eventual results of the manufacturing process. So then you need to find out, okay, we have used 10% more of material in order to manufacture this product. So what is the root cause for this? So once you examine the process step by step, then you can see, okay, these are the reasons. Mixing dose is incorrect, you have put more water, or you have put less water, or you have mixed it more time than you are supposed to do it. So likewise, you can figure out what are the lapses in your process. So what are the corrective measures that you need to take. So that will help us to correct the variances that you can see in your setup. And at the same time, when it comes to overhead, so you are basically supposed to utilize your oven only for half an hour, 30 minutes. So by chance, if you are using, let's say, 35 minutes or 40 minutes to bake that particular batch, which means that you are wasting your energy of the company. So there is an additional cost. So if you are putting more flour and spending more baking time, both will increase your cost. From one end, your material cost will go up, and the other end, your overhead cost will go up. Eventually, your estimated profit margin will get impacted. So you can't earn 25% profit margin that you have already targeted when you are setting up your selling price. Just because of your inefficiencies, you can straight away go and change your selling price. So you have basically printed that in your basically the packaging material, the MRP is 100, and also you have done all the communications to the consumer through the ATL and BTL activities. This is our product, and which is priced at 100 rupees, so anyone can have a tastier cake at 100 rupees. So that is the awareness that you have already given to your consumer base. So you can basically go and reverse. Sorry, there has been some errors in our organization. We are using more flour. The baking time is more by 10 minutes. Then we have to revise our prices. No, you can't do that. So that is why this variance analysis will help you to understand what are the gaps in the process and how to correct it, how to take the corrective measure. So that is basically called as a corrective measure or the control. Then when it comes to this variances analysis, actually you would have done the calculations. There can be certain negative variances as well as positive variances. So negative variances is what we just discussed. You have used more material, you have spent more oven time. So all these are cost. So those are the adverse variances that we can see. So similarly, there can be certain favorable variances as well. You are supposed to use 200 grams of flour, but in actual terms, you have used only 190 grams. So that is a benefit, right? So you are basically spending, you are incurring less cost on the flour, as well as instead of using 30 minutes of baking time, you are using only 25 minutes. So you are saving 5 minutes of the baking time. So you are saving 5 minutes of your energy bill, electricity bill. So the eventual results is you can earn a better profitability. Your expectation is 25 rupees per cake, 25% margin, but you can basically end up with 30% margin, which is a favorable situation to the company. So my question is, what is good? Is it adverse variance is good or the favorable variance is good? My answer is both are not good. If you are getting adverse variances, definitely you have to address it, because you are incurring, you are wasting company's money. On the other end, if you are getting a favorable variance, which means that there are many reasons to have a favorable variance. One thing is you have a recipe to produce a cake. So you develop that recipe in order to meet the expected quality. So you would have done certain consumer tasting session, consumer acceptance test before you launch this product. So consumers are aware of this particular product will come in this particular quality. So sometimes why you have incurred less material cost, you would have diluted your recipe, which will eventually result in a lower quality than our expectation. So which means customer will not accept your product. At the same time, sometimes you might get your standard incorrect at the time of doing the standard costing. There can be human mistakes. So you assume 200 grams per cake is what is required, but in actual terms it is 180 grams, so 190 grams. So which means you are basically done a kind of a mistakes in your initial standard when you are defining it. So the impact of that is you work out your selling price based on the standard you set, which is the 200 grams per cake. But actual usage is 180 grams, let's see. So you define your selling price as 100 rupees by looking at your standard cost. But even after you set your selling price at 100, you can see in the market there are certain competitors who are selling it at 90 rupees. So you must be thinking why they are selling it at 90 rupees, whereas I'm only going to sell it at 100 rupees. So now only you can figure it out. Okay, there has been an error in my calculation in the sense defining my recipe, defining my standard. So if you are not, as long as if you are not setting your standard correct at the first time, you won't get your pricing decisions correct. So in that case, what will happen? You won't get the desired sale out of it, and you won't reach the expected target market. You won't basically get the expected market share out of it. So both adverse and favorable variances are not good for an organization. So you have to basically stay within the standard that you have set. It doesn't mean you have to be 100% accurate and basically place put on your target that you have set. There can be slight variances. So in a manufacturing setup, what we are basically practicing is, for raw material we are allowing 1%, and for the packing material we are allowing 0.5%. So that is the the world class benchmark that we have across our manufacturing companies. So when it comes to the individual categories, so in the manufacturing setup, there can be industrial manufacturing, there can be consumer food manufacturing, so different types of manufacturing, personal care manufacturing, so different kinds of manufacturing setups will be there, industries will be there. So those industries will have different industry benchmark. So in general, what we are basically allowing is 1% for raw material wastages or the variances, and 0.5% for packing material. So if you are deviating from that percentage, then you have a real problem in your operation which you need to correct immediately. So that is how we are how we are basically controlling the organization by having a standard cost in place. Then the fifth one is the continuous improvement. So if we are basically happy with our current performance, and if we are generating the enough sales and enough profit margin, healthy profits, enough cash, we don't have any liquidity issues, then we must be very happy. But we must not be happy, because if we are doing our business well, we will be the benchmark for the rest of the place in the competition. So they are always eyeing on our operation. So at any given time there can be a challenge from any of these competition, because everyone is looking at our performance and they are trying to basically attack us and get some market share or get some consumer base out of our available customer base. So we have to be very mindful when we are in an organization, and if we are running our business in a very healthy manner by while operating in a healthy profit margin, we have to be careful and we have to come up with certain improvements in order to secure that place. For example, now this is our story. So our cost is 75 rupees and the selling price is 100 rupees. Now all of a sudden the competitor has gone and done a very huge marketing campaign and say, look here, we are giving the same cake, same taste, same size, same ingredient, same quality, but our price is 90. Then what will happen to your business? There can be certain cannibalization effect in the business, where certain customer base, certain customer uh, segment might shift from your cake to the competitor cake. So in that case, you will lose your revenue. So that is why you always need to do continuous improvement in your operation. So what do you mean by this continuous operation? Sorry, continuous improvement. So continuous improvement in the sense, now you set your benchmarks, you define your standard well in advance. But at the same time, in all these manufacturing companies, we have a separate research and development department. At the same time, there is a quality department. So those people are responsible to come up with certain new ideas. For example, you are using 200 grams of flour to manufacture a cake, but by evaluating the available suppliers and different uh, specification of the flour types which are available in the market, your R&D team might come up with a solution. Look here, there's another similar flour available in the market with a different spec, but you can manufacture the same cake using 190 grams of flour. So in that case, there's a benefit. We can use that 10 gram benefit basically to pass down to the consumer by way of a price reduction. And also there can be certain machines available in the market. Now here you are baking 10 cakes in a batch using 30 minutes. But there can be certain machineries where you can do an investment and you can do the same batch within 20 minutes. Or you can basically do many number of cakes, more than 10 per batch. You can do basically 15 cakes per batch in a half an hour. So in that case, you can basically improve your performance. So you can improve your GP margin. So that is why this continuous the standard will help you to continuously improve your performance. So what triggers that improvement is the standard that you have set. So you have the standard of 200 grams and 30 minutes of baking time. So since you have that standard, well-defined standard, then only you can basically look at what are the other opportunities available in the market to further improve your operation. So by doing our continuous improvement, we can be more competitive in the market. And also we need to now, let's say you are in a consumer food manufacturing company. So let's say you are in a uh, biscuit industry. So in the biscuit industry, you can basically compare yourself with the industry benchmark. So that industry benchmark may be a local benchmark or may be a world-class benchmark. So you can see the gap. Okay, we are using 200 grams. What is the world-class benchmark? You can basically go and see how those people are basically doing their operation. So likewise, you can improve your performance. Sometimes you can better the world-class benchmark as well. You are targeting to get into the world class benchmark, but with the expertise in your company and the expertise that you will have with the machinery and all that, you can basically do better than the world class benchmark as well. So you are basically setting up your benchmark. So that is why, that is how you continuously improve your operation. So as I told you before, this is the way that you can basically do the improvement. You can redefine your recipes. You can go revisit your material which are being used, revisit your supplier base available in the market, because certain suppliers must be keeping higher margin and selling the same product. So you can look at some alternative suppliers. You can look at some alternative materials. Then you can redefine your process rather than using 30 minutes to produce the one batch. You can how we can reduce it to 25 minutes. So likewise, you have to revisit your process. There can be certain non value adding activities in your entire process which dilutes your efficiency. So those things you need to be basically closely monitor and slowly take it out from your system. So then you can basically improve your uh, performance. And finally, the wastages. So there can be certain wastages happening in your plant. It can be a material wastage, it can be energy wastage, it can be idle labor. Sometimes you are uh, targeting a head count of 10 people, but actually you can get the same production out by using 8 people. So there are two idle labor there. So likewise, you can revisit the entire process, whether there are inefficiencies, whether there are wastages. So all these things can be done only when you have the standard costing in place. So the final and the last one is the performance evaluation. So performance evaluation is, I think, widely used in our organization. So when it comes to performance evaluation, there are different evaluations that are being done. So now, for example, in our John Keel's group, we are evaluating our business performance. Individual business are being evaluated, and the individual departments in an organization, how the quality department has performed, how the finance department has performed, how the procurement department has performed. So similarly, we are going into the detail, and the last and the most important thing is the individual performance. Each and every individual is evaluated based on the targets or the objectives that was set. Now, for example, if the production people are supposed to use only 200 grams of flour, but throughout the year, if they have used 210 grams of flour, then that entire department, including the individuals, have to be evaluated based on that excess wastage or excess usage that they have utilized. Similarly, if they have done certain improvement, continuous improvements, those will get highlighted and evaluated when it comes to the performance appraisal, because each and every department, each and every individual held responsible. Because once you set up this particular standard, now, in our example, the 200 grams of flour per one cake of to prepare one cake, that standard is not only applicable for the production team. That applies to the research and development team. That applies to the quality department. That applies to the procurement department. That applies to the logistic, the inbound and outbound logistics. So all the departments are basically taking a direct, maybe indirect ownership, stewardship towards getting this results in par with the standard that you are set. So if anyone is diverting from the standard, no, for example, production team had to utilize more flour to produce the same cake over the last year. Why? The reason is the purchasing team couldn't source it from the well-defined, predefined supplier. So they have basically gone and purchased it from another supplier which has a different spec of flour. So in that case, what will happen is there can be a wastage. So in that case, both uh, production team, the procurement team, as well as the quality team, because quality team is supposed to do the incoming inspection of the material, whether they are taking the right material into the manufacturing plant. So all these departments are collectively responsible to get into the targeted results. So as long as if you are deviating from the targeted results, then all the department has to be similarly accountable. So those will be evaluated at the performance evaluation, which is basically happening normally once a year. Certain companies are doing it on a biannual basis as well. So whenever they are doing the evaluation, the performance appraisal, those things will be considered. So standard cost, it is not just a book entry, it's not just a small calculation. So that will have a lot of repercussions in an organization. So a lot of core activities are basically driven by the standard costing that you have in an organization. So these are the things that I want to basically elaborate with regard to the practical application. So I think you got a better understanding on how we are basically applying the standard costing and it is usage in our day-to-day applications. So if you have any queries or questions, I would love to answer.
Tilna, I have a question.
Yeah.
First, thank you for a very comprehensive top-down, process which you explained to us. Now the cake example, the cake you took, it
Yeah.
is having a short shelf life.
Yes.
Likewise, the process time is very short, right?
Correct.
So in a scenario like that, how do you, now it's very important that we get the actual cost correct, right? So
Correct.
in a scenario like that, how do you account for the work in progress? And I think finished goods is okay. Finished goods, the material component, the raw material component, and the labor component is already complete. So you can
Correct.
take it as a finished cost. But when it comes to work in progress, the main components would be a raw material and the working the labor cost. How do you account for it when you are doing the various, and because first of all you have to establish the actual cost, right? Actual cost of
Correct.
material, actual cost of labor, all that you have to establish before you compare with the budget or standard, right?
Yes.
So how do you separate the two? Like I would like to know.
Yes. Uh, good question. But the thing is now, when we are working in an organization, as I mentioned you before, we are having an ERP system. So in that case, for each, I actually didn't go into that detail, because now if you look at our different types of materials available in an organization, we are basically categorizing it. So as I mentioned you in my presentation also, we have the raw material and packing material, so which is the preliminary level. Then we have the semi-finished good level, the SFG level, so which is in our uh, ERP systems. For each and every material there is a separate code. For example, flour, in our example, for flour and what do you call the cake box, let's say XX and YY. Then for the semi-finished product also, you have to define what is the semi-finished product. So that depends on how the organization defines your semi-finished product. Now, in this particular case, uh, as you very correctly said, this has a very short shelf life. So basically, once you mix your dough, mix your flour and the water and all that, you can't keep that dough as a semi-finished good, because as you complete it, you have to bake it. So your semi-finished product will be a unpacked baked cake. Then once you packed it, it will become a finished cake. So that is called as a finished product. Semi-finished good is called as the baked cake without putting it in a box. To further explain it, I will take an example from, because I have been in three industries so far: beverage, ice cream, and now right now I'm in processed meat industry. So in our uh, industries, in our real world applications now, we have, let's take an example from ice cream industry. So in order to manufacture an ice cream, you have the ingredients in your place. You have the fresh milk, you have the water, you have the essences, you have whatever the powders that you are using. So all these put into a mixture and you just mix it. Once you mix it, that particular mix is called as a semi-finished product, which is called as a base mix in our ERP system. So that is the base mix one. So that base mix is what is being used to manufacture the rest of the flavors. So once you have your base mix, you are basically going and confirming the system. Okay, I have done 1,000 liters of base mix. Then that base mix is converted to either vanilla or either chocolate, either strawberry, either fruit and nut. So then you are putting whatever the next additions to make it the second semi-finished product. So in that case, let's say we'll take the vanilla. So then you put the vanilla in your second step. So once you put the vanilla and mix it, then you call this as a vanilla base mix. Now you have two semi-finished good. The first one is the plain ice cream normal base mix. Then you convert into a vanilla base mix. Then you put it into a 1 liter vanilla tub. So once you put it on the vanilla tub only, that will be converted into a finished product. So until such time, in the previous two instances, in the system, it is getting recorded as an SFGs, semi-finished goods. So each and every semi-finished good, you have to have a separate recipe in the system. In the first semi-finished good, which is the plain ice cream mix, you have the recipe in the system. Okay, to have the plain ice cream mix 1,000 liters, you have to put this many number of milk, fresh milk, this many kilos of sugar, this many kilos of grams of essence. So likewise, you have to define. So once you put those material ingredients and mix it, that creates the first semi-finished product in the system. Then in the second semi-finished product, you have the vanilla ice cream base mix. So in that case, you are putting vanilla to that particular base mix, then it will get converted to the vanilla ice cream base mix. Still, it's a semi-finished product. Then you pour it into a 1 liter vanilla tub and freeze it. Then once you pour it and freeze it, then that is the final product that you have in your plant, which is called as the finished product. So once you put it into the the 1 liter container and freeze it only, this product will be converted as a finished product. So in order to answer your question, for each and every semi-finished product level, we will have recipes in the system.
Yeah, Thiran, I hear what you're saying. Now, with vanilla ice cream,
Yes,
that's okay. The raw material will get accounted correctly. But now, how about the wage component in your monthly accounts? They say you
correct.
have a
So,
variance
yeah,
in your
uh,
wages.
yes, that is. Let me explain it. So, the standard cost is basically twofold. One is you have the material cost. The material cost is directly taken from the bill of material, which is BOM, bill of material, which is defined in the um, system. And also the second component is the variable, sorry, the overhead components, where you have the energy, labor, uh, repair and maintenance of the factory. So we have basically five main manufacturing overheads in our organization setup. First one is the factory salaries and wages, which is the labor part. Then you have the machinery depreciation. Then you have the energy. Then you have the machine maintenance component. Then lastly, you have the other overheads, which are not basically classified in the first four line items. So those are the five cost pools that we have in our overhead classification. Then for each and every product, we have a not now similar to the bill of material. There's a another term called routing. In that routing, we are defining to produce, let's say, 1,000 ice cream tubs. You need 10,000. 500 manning hours. Then 2 hours of machine hours. Then let's say uh, 3 hours of freezing time. So likewise, you are basically defining the subcomponents of the overheads in a platform called routing. So the routing is also similar to bill of material. So in the bill of material, what you are basically defining is the material usage, material X, Y, Z. But in routing, what you are defining is labor time, machine time, freezing time, packing time. So likewise, whatever the work centers which the products goes through, you have to define the timing. So based on the timing, then in the system we have already uh, uh, feeding the, what do you call this, overhead absorption rates at the beginning of the year based on the plans that we are doing. I think overhead absorption rates calculation you would have done in your previous cases. So once the overhead absorption rates are calculated, we are basically feeding into the system. So that basically work out with the routing. Okay, if 1 liter of vanilla ice cream has to take, let's say, 2 hours of mixing time, then in the system you have what is the overhead absorption rates in the mixing component. For labor you have to use x rupees, for machine you have to use y rupees, then for maintenance you have to use x rupees. So likewise, we have already defined the overhead absorption rates in the system, and also you have the routing in the system saying you have to spend this many number of hours. So it's just a multiplication of the hours that you spend with the predefined overhead rates in order to work out the uh, overhead part. Then that total cost will be added to the material cost, and system will work out the total standard cost. So it is a very lengthy process which we are having in place, and you have to go into the details of each and every workstation. So I think to answer your question, basically the overhead part, the labor to machine overheads, energy, those will be captured in another how do you call the standard called routing. So that is also something similar to bill of material.
Yeah, okay.
Hope I
Thanks, Thiran.
answer your
Actually, for
question.
you, it's not a big problem for you because your process time is very, even for vanilla ice cream or even the cake, the process time is very, very short, right? Maybe less than a day. But
Yeah.
for an organization which has a long processing period, then it becomes important. That's the reason why I asked the question. How would because it becomes a big process. Exactly arriving at the labor variances and the variable overhead variances, it becomes a bit of a difficult task. That's why that's the reason behind the question. For you, I think it's easy because your process time is very short, so the variances might not be very
Very sure, yeah.
significant. Yeah. Okay. Thank you.
Only thing is you have to get the correct timing at the first
Yeah.
time. So
Yeah.
it may be a very lengthy process. For example, now if you look at this injection molding plants where you prepare your empty PET bottles, plastic containers, and all that. So it's a very lengthy process, and it has a very lengthy cycle times. And even if you look at this tile manufacturing plants, their main bottleneck or the main pain point is the oven time. So they are operating the oven uh, 24 into 7. So they are basically not shut down the plant unless there is a regular maintenance which is happening. That is also planned one. So unless for these regular maintenance, those operations are continuously happening. So in that case, you have to get the correct, basically accurate figures uh, from the basically the R&D team, the research and development team, and the quality team has to take care of those figures, and they have to give the correct, accurate figures. Then only you can basically measure the accuracy of the performance. So basically, if you are now when you are doing this calculation in a spreadsheet or a worksheet, it looks like very easy, but when it comes to real world application, so you have to basically go through the entire process and understand the subcomponents of the process and where what is the resource utilization in the individual sub processes. So that will be a very lengthy and a comprehensive process. So the importance is you need to have the fundamentals in order to get into that level. So once you get the fundamentals right, and once you have the solid foundation on the standard costing, I think then it's just a matter of applying that in the way that fits into your organization.
Yeah. Okay. Thank you, Tilna.
Yes. Any questions?
If you have any clarifications, you can ask. Right. Seems there are no more questions. Actually, they were asking so many questions and clarifications. That's really good. So, Mr. Tirina, thank you very much once again to giving us a comprehensive understanding about standard costing. Actually, they were learning theoretical aspects, but you explained the practical aspects within different industries, and that's really good. Thank you very much for your time. Uh, Yes, so students, thank you very much. This is our last session. So I hope you can remember the assignment guidelines. I will ask
Sorry,
TA.
Natasha, there are certain questions I just saw in the chat box. One has asked, in a highly information situation, customers become more price sensitive and consider the price demand elasticity and the level of competition and the target market, the company future prospects. How you access those when deciding the standard cost and the sales price? Yes. So that's what. So in order to answer this question, so she's asking in an inflation situation, the prices are going up, and so the consumers are very price sensitive. So in that case, how do you use standard cost when you are setting up the selling price? So in that case, I think we need so. When you are doing the standard cost calculation, so when the prices are going up in the market, it's not only in the finished products as well as that will reflect in the raw material prices as well. So on an organization, what happens is the standard cost is getting calculated on a monthly basis. So current month you are basically work out your standard cost based on the weighted average price of your incoming raw material, so that you have taken as a base. So then you know at the beginning of the month, this is the price that I'm going to value this particular product, and this is the standard cost. So if the prices are basically has gone up in the market, that is also get reflected in the standard cost. In that case, you can take a corrective measure in your final pricing. But the thing is, the volatility in the market, especially the incoming raw material and the incoming packing material, there can be frequent volatilities. But while having those volatilities in the market, you can basically go and change your MRP on a monthly basis. That will really disturb your customer base. So that is why when you are having a better pricing, better buying, then you will have a better profits. At the same time, when the prices are up in the market, then your margins will get diluted. So you have to basically have a kind of a cushion when you are setting up the selling price. As in my example, I put 25%, but you may consider 30% or 35% just to bear that, just to absorb that kind of volatilities in the market, because whenever there's a price change in the market, you can just go and increase your selling price. So similarly, you can reduce the you can't reduce the selling price as well, because you might carry a substantial amount of packing material where the price is already printed in the packing material. So you have to consider that as well. And sometimes you might have certain contracts with your customers saying, okay, I will offer this product for 6 months, the first 6 months at this price. So you have to be very mindful when you're basically setting up your selling price. And there's another question. Can you further explain the organizational benchmark in your industry? Yes. Now, uh, when it comes to this benchmark, so that is what I said. Actually, I can't. I have my internal benchmark that can be basically share with you, but basically, since I'm still working for that organization, I'm not authorized because it is not professional. Even if I leave this organization, it is not professional to disclose those kind of internal industry benchmark. But in general, in the manufacturing setup, that is what I told you. When you are basically looking at your material cost, the material usage variances, you can't basically go beyond 1%. So 1% is the maximum maximum amount that you can basically allow. And when it comes to packaging material, that is the 0.5% of the wastage. So if you are basically exceeding 0.5% of the wastage, then there is a basically a question, basically a gap in your current process which you need to rectify. So when you are working in a different organization, you will get to see what are the industry benchmarks. So we can basically, if you are in an ice cream industry, you can just Google it and see what is the material wastage that you basically have. And please note that there are certain depending on your industry that you all are working, the this benchmark can be varied. So though I'm saying the raw material wastage is 1%, there can be certain industries where the inherent material wastage is 5%. So you can't basically do anything about it. For example, I will give you, when you are in a packaging material manufacturing company, when you are producing corrugated boxes, based on your die cuts, the orientation where you cut the cardboard, there can be certain inherent wastages. So irrespective of the manufacturer who does it, they have to incur, let's say, 10% of the material wastage. So it is inherent thing in your process which you can't basically answer. So those are the things you need to absorb in your uh, accounting, the costing system, and that is also basically depend on your particular industry that you are working in. Then there's one question: what is the best costing method for a shrink machine having RM directly purchased semi-finished product and couple of processes RM? I'm not quite clear on the question. Is what is the best accounting costing method having RM directly purchased? Sorry, I can't get that question because the way he drafted the question is not basically clear enough for me to answer. Natasha, if you can get that question, I can basically give an answer offline.
Right. So you can send me the answer in the WhatsApp group, then I can forward it to Mr.
Sure.
The answer. Right. So yeah, since we have exceeded the time, I'm ending the session now. Thank you very much, Mr. Tirina, once again for giving us this valuable opportunity for the students. Thank you very much on behalf of Nuance as well. Right, students. So we'll end the session. And if you have any clarifications, you can use the WhatsApp group. And don't forget the assignment deadline. And you have to submit it for the certificate of completion. So thank you very much. And good luck for your future endeavors. Thank you very much for joining. And yeah.
Yeah, Natasha, on behalf of all the students, I just want to say that you have been awesome in conducting this whole session. The preparation, execution, everything has been really good, and it has been a pleasure, listening and following everything. You have been very patient as well. Thank you very much. Wish you also
Okay.
the very best.
Yes. Thank you very much. Yes.